MAPI, as the Association of Indonesian Valuers, contribute and plays an active role in Indonesian infrastructure, rapid development, economic growth, and tourism industry. Established since October 20, 1981, MAPI became an independent non-profit and non-political professional valuer organization in Indonesia. Currently, MAPI has been recognized as part of and in collaboration with international valuers institutions and associations such as AVA, BBC, IVAC, YAKVA, RICS, API, Appraisal Institute, KAPA, and JAREA. MAPI vision is to equip Indonesian valuer with integrity, professionalism, and international exposure. MAPI mission is to enhance Indonesian valuer through continuous education, research, ethic, and standard. Developing Indonesian valuer with international insight. Improving the quality of Indonesian valuer. Participating in national development. Creating a valuable valuers that keep MAPI honor and dignity. Creating and maintaining a conducive business of valuation and related services. And creating a good governance in national and international perspective. In accordance with MAPI's vision and mission, Indonesian valuers support the government to accelerate the national economic growth through its role and contribution as valuer of bank credit assurance, supporting profession in capital market, valuer in optimizing the utilization of government assets, valuer in financial statement reporting, and valuer online procurement for public interest purpose. The number of MAPI members currently are more than 9,000 people and spread all over Indonesia. And those numbers will continue to increase along with the organization need for competent human resources to create integrity, professional, and international standard Indonesian valuer.
Behold, the beauty that is Indonesia. Mother Nature's gift of serene and colorful landscapes, where diversity makes us one, united towards a common goal, where resiliency is achieved together. A strong infrastructure governance arising, where investments are waiting to flourish, and where creativity is inspired by tradition. Indonesia, where beautiful possibilities are offered.
MAPI, as the Association of Indonesian Valuers, contribute and plays an active role in Indonesian infrastructure, rapid development, economic growth, and tourism industry. Established since October 20, 1981, MAPI became an independent non-profit and non-political professional valuer organization in Indonesia. Currently, MAPI has been recognized as part of and in collaboration with international valuers institutions and associations such as AVA, BBC, IVAC, YAKVA, RICS, API, Appraisal Institute, KAPA, and JAREA. MAPI vision is to equip Indonesian valuer with integrity, professionalism, and international exposure. MAPI mission is to enhance Indonesian value through continuous education, research, ethic, and standard. Developing Indonesian value with international insight. Improving the quality of Indonesian value. Participating in national development. Creating a valuable values that keep MAPI honor and dignity. Creating and maintaining a conducive business of valuation and related services. And creating a good governance in national and international perspective. In accordance with MAPI's vision and mission, Indonesian valuers support the government to accelerate the national economic growth through its role and contribution as failure of bank credit assurance, supporting profession in capital market, failure in optimizing the utilization of government assets, failure in financial statement reporting, and failure online procurement for public interest purpose. The number of MAPI members currently are more than 9,000 people and spread all over Indonesia. And those numbers will continue to increase along with the organization need for competent human resources to create integrity, professional, and international standard Indonesian value.
Good morning, ladies and gentlemen. Greetings from Indonesia and welcome to Road to 24th ASEAN Valuers Association Congress International Webinar about Intellectual Property Valuation for Financing. We are so honored to be given the chance to host this event. My name is Evika Saragi and I will be your Master of Ceremony for today. In this event, we'll be talking about various issues around intellectual property valuation for financing for the next 3 hours. I am delighted to inform you that we are going to hear directly from the 3 experts in this field. You can ask questions to our experts by submitting your question using Slido. The Slido link and attendance form can be accessed through the link in the chat box and also in the YouTube description box. Ladies and gentlemen, before we get into the topic of our webinar, we're going to hear an opening speech by Mr. Muhammad Aidil Mutakin as the head of Indonesian Society of Appraisers. Please welcome Mr. Muhammad Aidil Mutakin.
Okay, thank you, Master of Ceremony. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Good morning and welcome to the all participants. Honorable our AVA President Bapak Firman Syah and Nazaruddin, Honorable all speakers and moderator, Mr. Afila Jain, Managing Director India Crow, Mrs. Datuk Lau Waishang, Chairman Scott International Malaysia, Mr. Budi Martokusumo, and the moderator partner of PricewaterhouseCoopers Indonesia. First of all, on behalf of AVA Indonesia, I am pleased to welcome you to the road to 20th 24 AVA Congress International Webinar with topic Intellectual Property Valuation for Financing. We know intellectual property has become area in debt financing in Western countries, but still not generally development in Asia due to the specific risks associated with financing, current market situation, and lack of support from the regulator. This webinar is intended to give an insight on the challenge that valuers should face in valuing IP and to identify the key factors which impact the IP valuation. This international webinar is attended by more than 1,500 participants from all over the world, from USA, Canada, UK, China, Japan, India, Taiwan, South Korea, and heavily supported by our neighborhood ASEAN country, Malaysia, Philippines, Thailand, Vietnam, Singapore, and Brunei. In this virtual conference room, we recognize some familiar name of participants from Valuer Association, Accountant Association, banking and government sector, and we are a warm welcome to all of you. AVA Indonesia, which the member of AVA, is a combination of Indonesian Society of Appraisers, Finance Profession Supervisory Center under Ministry of Finance, Republic of Indonesia, and educational institution jointly hold a series of meetings and events called Road to 24th AVA Congress, through which various events were introduced to the general public, educational institution, and valuers to give them a knowledge of the existence of ASEAN Valuer Association as an association that accommodates all valuers in ASEAN. This international webinar is part of the responsibility of AVA Indonesia, especially in its position as the permanent secretariat of AVA, to be able to contribute to the development of valuation work in ASEAN and international world. This year, in 2022, AVA Indonesia will be the host of the 2024 ASEAN Valuer Association Congress, which will be held from 22nd to 24th of November 2022 in Hilton Bali Resort, with the theme of the Congress, Emerging Stronger Valuation for a Strong Recovery and Sustainable Future. With a strong and experienced working team in holding the 21st AVA Congress in Yogyakarta in 2018, we hope to repeat the same success story where more than 450 local and foreign participants and international speakers attend the Congress. In upcoming 24th AVA Congress in Bali, we will facilitate ASEAN regulator and supervisory to discuss and share their experience with the audience and the panel discussion on the topic of regulatory and supervisory framework for failure. In line with the three main pillars to its G20 presidency 2022, we will also discuss about environmental, social, and governance on business relation. ESG has become an important criteria in the business and are used to screen investment based on corporate policies and to encourage companies to act responsibly. Along with ASEAN, along with asset valuation, business valuation in Indonesia has fully fledged from a simple into multiple business model and regulation. And we would like to learn together and share the panelist experience to the audience. We also invite to all ASEAN valuers to submit the paper on the topic of the first valuation and benefit of green development. The second, defining social value on real estate valuation. The submission of the paper abstract will be on September 1st, 2022. The detail of the panel, the detail of the paper, subtopic, and requirement can be obtained on AVA new website. The Secretary General will inform you the address of the website later. Before I close the speech, I would like to present the short video for the upcoming event. Please play the video. Thank you. On behalf of AVA Indonesia, I would like to invite all ASEAN valuers to attend the 24th AVA Congress, which will be held on November 22nd and to 24th in Bali, Indonesia. Please ensure to register for the upcoming event. More detail of that AVA Congress shall be obtained through our website, asean-valuers.org. There is also a special early bird fee for those of you who registered prior to October 1st, and a special room rate for Hilton Bali Hotel Resort to the link on the website. See you all of you in Bali soon. Thank you very much. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you so much, Mr. Muhammad Aidil Mutakin, for the opening speech. Ladies and gentlemen, before we move into our main event, we are very pleased to inform you that the chairman of Finance Professions Supervisory Center from the Ministry of Finance of Indonesia will be, and also the 2022 president of Asian Valuers Association will be giving a keynote speech. Please welcome Mr. Firmansyah and Nazaruddin.
Thank you, Vika. Honorable Chief Delegates and Delegates of AVA member countries, and all distinguished speakers, guests, and participants. Assalamualaikum warahmatullahi wabarakatuh. Good morning and best wishes for all of us. Greetings from AVA Indonesia. It is a privilege to welcome you all to the webinar Intellectual Property Valuation for Financing. We also convey our gratitude for having AVA Indonesia to host this webinar as part of Road to 24th AVA Congress. Ladies and gentlemen, intellectual property is the ultimate legacy from human existence all of time. This important property is generated from human special feature to process its thoughts and feelings creatively to produce a creation. Diversity in thought process makes its individual a unique being. Recognition of intellectual property is not a suddenly emerging awareness. It has been around for a long time. Attribution of scientific writing to specific author has been part of intellectual property acknowledgement despite lack of formalization in past. Inscription of the artifact attributed to certain creators living in early kingdoms in Indonesia are great examples of such a recognition. Based on that perspective, it is highly probable that the end of the prehistoric era or the time when writing documentation of human history existing for the first time was the beginning of intellectual property recognition. In the next period of human history, a need of formulation of intellectual property recognition emerged. In 1470, problems related to the patents were rising in Venezia, Italy. Invention made by stellar inventors such as Galileo and Archimedes created a need, regulation, and monopoly rights. In 1793, Fichte, a German philosopher, introduced the terminology of intellectual property for the first time. He stated that property right of a creator lies in his book, meaning that the right lies the creation itself. That was a progressive movement in preserving creatively through recognition of intellectual property properly. In other words, it was an act preserving the existence of human race. Ladies and gentlemen, recognition of intellectual property is basically propelling the creation of the new inventions. Meanwhile, the invention itself is actually the catalyst of development of new economic potentials. Inventions that have changed the world, such as electricity and communication, offer new corporation work opportunity to emerge and develop. Moreover, those emerging corporations accelerated the development of supporting industries. Job creation was an automatic consequence and later on would increase life quality of many people. Thomas Alva Edison, who had more than 1,000 patents, for instance, collaborated with Elihu Thomson in establishment of General Electric in the end of 19th century. As we all know, GE nowadays is a multinational company placed in the vast area like aviation, healthcare, energy, digital industry, and other domains. This is a real example of the intellectual capability and property boost creativity and competitiveness, which in the end will create sustainable economic development. Creative industry is an ideal home for development of intellectual property. The industry provides rooms for young inventors to expand their innovation as part of value creation of new products or enhancement of existing product. Economic value may serve a standard to measure the benefit derived from a new invention to an individual or a company. The measurement cannot be performed accurately without protection of intellectual property rights. It is absolutely in line with basic concept of attachment of the value right of the valued property. Ladies and gentlemen, protection of intellectual property is essential and support of the government in its development is crucial. Regulation provide legal certainty to entrepreneurs and investors. Incentive and ease of financing would also provide fresh air to the business. In addition, other government supports like law enforcement to violation of intellectual property rights facilitate the environment stability. Utilization of intellectual properties as underlying assets, its financing is a breakthrough for IP development. IP valuation is obviously challenging because of limited historical data, especially that of new inventions. Different treatment applies to the older inventions as it would be easier to measure. The previous achievement provides the appropriate value of IP that eventually would help financial institutions to decide, decide to invest certain proportion of capital. In other hand, the existence of IP as intangible assets as well as variety of policy on IP protection across countries create a complexity. Valuation for the purpose of accounting, tax, and transfer pricing, and valuation used for IP backed on loan security may need different treatment in their practices. Ladies and gentlemen, despite its grave effect on people's health, COVID-19 pandemic accelerated the use of Internet of Things in business. Hard asset lights, service business, especially performed by unicorns, are new promising business model. Capital assets position is no longer a priority and investment are used in majority for company operating purposes through use the internet. It is undeniable that those business models are part of IP through the utilization of information technology. They are rapidly being duplicated and modified by entrepreneurs in wide range of domains, from telemedicine practices in healthcare to educational application in education domain. The scheme of hard lights service business later on strengthens the myth of IP as underlying assets of its financing. The reason behind this is enormous scale of business that is not equivalent to the value of physical assets owned by business. Sharing economy scheme used by unicorns like Gojek and Uber makes the ownership or existence of their assets is not comparable to their business scale. It is just because the vehicles as the backbone of the company are not under Gojek or Uber real ownership, but belong to drivers as business partners. Failure of IP financing may entail considerable risk for both financial institutions and borrower. Decisions of IP as debt guarantee is susceptible to failure in paying off the debt. It arises from unachievable projected income that also decreases the value of IP. Based on that risk, IP financing is very challenging option for conventional financial institutions. Such issues is captivating and engaging discussion topic since successful of IP financing may give a significantly positive effect in economy as the failure of may bring of the financial trade. Based on atmosphere I just mentioned before, we initiate the intellectual property valuation for financing webinar today. This event is a part of Road to 24th AVA Congress series of events. In line with the Congress, we believe that the events creates great encounter for ASEAN valuers and share knowledge on valuation practice for creative economy financing that can support sustainability economic development. Finally, we encourage all of the participants to optimize your presence here. So we would like to express our apology if there is any inconvenience or imperfection during the webinar. We also looking forward to inputs from all participants for better improvement in the future. Thank you. Good morning. Wassalamualaikum warahmatullahi wabarakatuh.
Thank you so much, Mr. Firmansyah and Nazarnin, for the keynote speech. Before we proceed to the main event, I would like to remind you that to ask questions, you can submit your questions using Slido. The Slido link and attendance form can be accessed through the link in the Zoom chat box and YouTube description box. Please stay until the end of this webinar because in order to get a certificate, there's a keyword that needed to be submitted that I will drop randomly. Ladies and gentlemen, in this webinar, we'll be talking about intellectual property valuation for financing. The presentation will be delivered by our distinguished speakers, Mr. Aviral Jain, the Managing Director of Kroll India, Mrs. Dato Laweseng, the Chairman of IELTS International Malaysia, and Mr. Budi Marto Kusumo, the Managing Director of Marto Kusumo, Pakpahan and Associates Valuers Firm, and also as a member of Indonesian Valuation Standards Development Committee. Each session will be guided by Mr. Triyono Sudirjo as our moderator for today. Mr. Triyono Sudirjo is a partner of PricewaterhouseCoopers Indonesia since 1999. He completed his master's degree in Science in Financial Economics from the University of Warwick in 1994. Please welcome our moderator for today, Mr. Triyono Sudirjo.
Good morning, selamat pagi. Member of the AVA, thank you very much. This is a very honorable opportunity for me to be your moderator for this distinguished event as the Road to the AVA 24th seminar anniversary. Okay. I think the topic today is very, very interesting. We are going to talk about the IP valuation for financing. IP itself has been very important stimulus or a very important element of the business development. Maybe we could show a slide to show the development of the IP in the business world. Sudah. Yeah, looking at this, it's quite clear that there is a significant explosion of the IP rights in force, primarily dominated by the trademark, going into 65 million in total, followed by the patent at about 15.9 million. This is always continue to grow because more and more we're going to go into more IP-based economy. So this is just a backdrop that will be further explored by our speakers. Let me introduce you to our speakers. Our first speaker is Mr. Aviral Jain. He has been over 15 years of experience in valuation, corporate finance, and doing restructuring, working with the crawl. His expertise is on the valuation of business enterprises, intangible assets, and intellectual property, as well as financial instruments. He's educated in University of Delhi for MBA. And then also, same with me, he's also a CFA charter holder, and he's got a designation in ICPA. Currently, he is managing director in Kroll. Formerly, it's called Duff and Phelps, one of the distinguished professional services firm in corporate finance and valuations. Previously working at the KPMG in corporate finance in Deloitte. He's been working in a number of thought leaderships in the CII National Committee of Intellectual Property, as well as the author of Celebrity Brand Valuation. Do we have his presentation ready? Okay. Okay. So without further ado, I would like to invite our first speaker, Aviral. The floor is yours.
Thank you so much. It's really a pleasure to be invited to speak on this topic of IP valuation at our Congress webinar today. And I'll straight away jump into the deck. I hope the screen is visible.
Yeah, this is good. Okay.
Okay, great. Thank you. So the topic for my presentation is on IP as a business asset, a tool for strategic growth and financing. Before we start, I would like to start with the preamble, especially being in an IP event, that the examples and the pictures which are used in the presentation today are only for the purposes of illustration. And all the named case studies, they are sourced from public domain. All their trademarks, trade names, and logos are properties of their respective owners. And this is very critical because in my presentation, I intend to cover some of the case studies in and around IP. Starting with the agenda, I plan to cover three major topics. The first one being IP as a business asset. Second one on various modes of IP financing. I think this has become quite an interesting and a topic and also a business decision which everyone is looking forward to, though some of the commercial banks still are lagging behind in financing IP, but we look at some of the examples which are there with us. And finally, talk about certain business transactions where IP played a major role in the M&A transactions. Moving on to the first section where we are talking about IP as a business asset. Now, if we see over time, how has IP contributed to the business? Primarily, there are three major factors. The first one is to drive innovation. With increasing IPRs, investment in R&D, the IPs provide competitive edge in the long-term business success. You know, if we look at technology sector, we look at pharma sector, and if we look at the R&D expenditure, the research and development expenditure in these companies, I think it would be a significant portion of the overall revenues. The second element of IP driven business growth we can see in the franchising and product distributions, where these by business by having intellectual property assets, by having patents, by having trademarks, it is much easier to allow for franchising distributions to grow the business. And some of the examples we can see is in consumer and retail industry. Further, IP is now being used as a tool for additional raising funds, for seeking capital from the VC investors, from private equity investors. Of course, the large debate still remains on the financing, the traditional route of financing from the commercial banks. But from a PVC perspective, it's become very active. And why is it that IP is driving that role in business? So if you look at the chart below, the below chart shows the rising proportion of intangible assets in a business. This chart shows how over the last 40 years, 50 years, has the contribution of intangible assets in a business changed over time. This chart represents a snapshot of S&P 500 companies. So if you look at the leftmost bar, that represents the contribution of tangible assets and intangible assets in 1975, which is about 83% for tangible assets and 17% for intangible assets. However, fast forward 40 years, or if you see the chart again, it's actually reversed. Almost 84% of the value today in the balance sheets of these companies, of these listed companies, is driven by intangible assets. So clearly, intangible assets have played a major role in the growth of these companies. Now, the other factor which is very critical is how has IP helped these businesses grow by way of acquisitions? Because we have seen in the past there have been multi-billion-dollar mergers and acquisitions, and a large sort of role has been played by the IP portfolio. For example, if we notice the transaction where United Technologies merged with Raytheon. Now, this company was UTC, which is United Technology, was providing technological services, product and services to building systems, aerospace systems, while Raytheon was actually producing the missile defense systems and cybersecurity systems. Now, when the two companies merged, they created a portfolio of 38,000 active patents with a revenue of about $74 billion. Now, given their leading positions in the aerospace and defense industry, and by combining synergistic portfolios, they actually created a kind of a monopoly situation for themselves. The other example I have is from India, is from Dr. Reddy's. Dr. Reddy's is a pharmaceutical company into creating and manufacturing drugs. Now, when it started off with a mere $0.04 million in cash and $0.12 million bank loan and a single product. But what the company did and what the promoters did is that they kept on investing in research and development, kept on doing continuous R&D, and that transformed the company into one of the largest drug innovation companies in India. It became the first Indian pharmaceutical company to launch an NCE, which is new chemical entity. And now it researches patent databases to find regulatory exclusivity periods, which are getting expired or have just expired, and launch quality yet cheaper generic drugs. So if you look at the chart, which is on the left, this is the percentage contribution of revenues from their R&D segment or from their proprietary research segment, and it has increased significantly. In 2005, for example, we were looking at 63%, and it's almost touching 86% today. So very large part of the success, I would say, is driven by purely from their IP portfolio. Another example, I think all of us would have seen the company Domino's and maybe tried their pizzas. And now the company doesn't require any introduction, but the the model of the Domino's growth has been driven by a successful franchisees, which they have globally. And behind that successful franchising is actually a portfolio of patents and trademarks. They have almost 23 patents, out of which 16 are active. And some of these patents include the cheese distributors, the food delivery hot bags with electric hot plate, dough preparation apparatus, stackable dough tray, etc. So these are all process driven sort of patents which they have. Further to the portfolio of these patents, they also have very strong trademarks. For example, in India, they use a campaign, Khushiyon Ki Home Delivery, which means that they're delivering happiness to your home, and that's a trademark they have registered. Similarly, for all their products, apart from the, of course, the three dot logo, but even the products which they have, they hold trademarks, and that helps them, to kind of easily go forward and do the franchising model without worrying about business being captured by some other competitor or some other franchisee player who may want to launch his own business because they have patents and trademarks against each of their key items. In return, of course, they also make good returns. They get a 5.5% royalty rates on the sales on a weekly basis. So it's a win-win situation to grow faster and also have a very protected sort of a regime on their own assets. So these were some of the examples which I had on how IP is being used in business, how uh, different businesses have actually used IP for much higher growth and becoming much more profitable. The second part of my presentation is on IP financing, where we're going to talk about what are the various trends which are going in IP financing today. Now, we saw the chart, if you recall, in my first few slides on how companies have a larger portion of intangible assets today, more than around 85%. And with these growing intangible assets, the contribution of the IP portfolios in this intangible part of balance sheet is also growing. So clearly, if a bank today wants to finance a company, it has to look at, the first thing the bank does, look at the balance sheet, look at the assets in the balance sheet. Now, if the size of the fixed assets have gone down, so and the intangibles have gone up, I think there's no option but to also look at what kind of assets are there. And within intangible, of course, IP is a category of assets which are legally protected, which are strong, which can be enforced. And from that perspective, the collateralization of IP assets is becoming as a viable alternative to traditional financing on fixed assets. Now, apart from pure IP, what we have also seen is the commercial banks and other institutions are looking at the overall portfolio of intangible assets in the business. So they look at what kind of innovations the business does, what kind of customer relationship it has, what is the brand image, etc. Because put together, it's a portfolio which one needs to get convinced with. Of course, before any transaction take place, the value of the and the underlying value of the IP is very important. How we carry out that valuation, how do we quantify the benefits from that IP, what is the cost of development and its maintenance, what is the role of IP in overall income generation, and finally, they also want to look at what is the value of the IP in isolation from the company. So for example, tomorrow, if somebody wants to enforce their collaterals, then will the IP have value on a standalone basis? And will it create value for the market participants or not? So these are some of the considerations which are very important from a financing perspective. Some of the recent trends which we see on IP financing, unfortunately, we do not have too much data around what is the kind of financing taking place against purely an IP assets. But based on some recent studies by a third party, Relicura, they track the number of IP backed transactions, IP backed financing transactions by major banks like JP Morgan, Bank of America, and Citigroup. This is focused more on the US markets, this data point. And the below table shows how the number of applications have been fairly robust across the sectors including digital storage, data processing, digital communication, and medical devices, where a large part of patents is sitting today. Now, what are the various ways of IP financing? Because it's very important to understand how do we finance our IP assets. The first and the immediate sort of way is direct collateral. Direct collateral is nothing but pledging your IP assets as a collateral in the loan agreement, so that if tomorrow things go south, the lenders can seize the firm, can seize those IP assets if there is a case of default. Now, this is of course the most preferable route for IP financing. However, what we've seen is that there are mixed trends based on different geographies, the way the banking sector has opened up over a period of time, and also the regulations which are playing in the local region. The second aspect of IP financing, or the route of IP financing, is securitization. Now, under securitization route, the IP assets can be securitized by creating an SPV, which is special purpose vehicle, placing those IP assets in the SPV, and in turn issue securities in the capital markets, which will fetch certain returns to the investors. The returns come from the fact that the IP portfolio, which is getting securitized, will have certain rights to its projected revenues. Basically, let's say you're getting certain royalties on your trademarks, or you're getting royalties on your technology patents. So there's a certain set of cash flows which are coming to that SPV. And from that SPV, whatever bonds have been issued, whatever securities which have been issued, their interest and their repayments can be serviced by way of those cash flows. Now, in this transaction, or in this structure, the lending institutions or the investors actually eliminate the risk of directly holding the IP, because their securities are actually in the SPV, which owns the IP and which can have its own management running it. Whereas if you look at the direct collateral part, if lenders were to enforce the securities and take control of the IP assets, the problem is who's going to run it, who's going to monetize the IP, and will it be as efficient and as effective as the erstwhile promoters were? So that helps banks alienate that part of risk. The third type of financing route is a sale and leaseback route. Now, in a sale and leaseback route, an IP owner reaches out to the investor, and in exchange of funding from the investor, it actually sells its IP asset to that investor. Now, at the same time, once it's sold the IP assets, it enters into a perpetual lease or a definite lease period for leasing back that asset exclusively to its own business. And against that, it starts paying the royalty transaction. So it's very similar, in terms of principle, if you look at the securitization model. However, here you're dealing with one specific investor, right? And there could be certain specific conditions, specific terms, specific periods during which the sale and leaseback transactions will continue, which effectively means that tomorrow at the end of that term, the original IP owner can actually buy back that IP asset at a predefined price. So that gives a lot of comfort to both the sides, because selling that IP assets again for the investor might be difficult to a third party, especially if it has unique benefits. Whereas for your own, for the erstwhile IP owner, it is something which is always relevant for the business. The fourth and the final way of IP financing is venture debt. Now, this is something which we've seen is really growing faster than the traditional commercial financing, because the venture debt investors are ready to take risk. As we look at certain startups, certain early stage companies, we see that today a lot of these startups and early stage companies are spending heavily on building their technology, on spending heavily on digital platforms, are spending heavily on their IP portfolios or intangible portfolios. And from that perspective, even if these are loss making, while traditional commercial banks may not prefer financing such companies, however, from a venture debt perspective, venture capital investors perspective, this is something they like doing it in and out. and that gives rise to the direct equity financing. And of course, that is something which has always been there, where private equity players put money in IP-rich companies. They're ready to invest, they're ready to wait and get the higher returns in the coming periods as the companies become more stronger and profitable with stronger IP portfolios. Now, few examples which I have today to discuss. The first one is one of my favorites case study. It's for MBT. It's for Masai, a company which used to manufacture special shoes and sandals for fitness and orthopedic benefits. Now, this company in 2008 patented a technology for footwear known as Masai Barefoot technology, which provided a natural instability underfoot, which stimulated the body's muscle system. Basically, in a nutshell, good for your foot. However, because of low price counterfeits, which came from various countries, the company did not survive and it had to file for bankruptcy. Now, when it filed for bankruptcy, it was acquired by a Singaporean shoe distributor. And after acquisition, they actually went to an MNC bank and used IP, which is this technology, as a collateral to get some funding. They used the loan for IP protection, for further R&D, and some part towards advertising the brand and some administrative fee in IP registration. And since then, the company has actually done very well. And this was one of the successful sort of financings under the IPOS scheme in Singapore, in which the company actually turned around its operations, where IP was used as a direct collateral. The second case study we have is on the securitization side. And this is slightly old case study where, if you notice, one of the famous English musicians, David Bowie, he issued a 55 million bond with a 7.9% annual return. And that bond was actually backed by its own copyrights to his songs, about a portfolio of 287 songs. Now, this portfolio of songs actually used to attract certain royalties from various third parties. And those royalties backed portfolio was actually securitized to issue bonds to the investors. Now, as the royalties came in, the cash flow was generated in the SPV, which allowed the bond investors to get interest and also principal repayments. Now, this bond structure was such a successful one that it was actually known as celebrity bonds at that time. And some of the other musicians also then tried, imitating that structure for themselves. However, if from a traditional commercial bank perspective and a practical perspective, what we see today is that there are challenges in getting pure debt financing, especially from a traditional commercial bank. And these challenges, one of the foremost challenge or one of the underlying problem today is, how do you realize the value of the collateral, especially when we are talking about IP? Because giving a loan is an easier part, monitoring it is another part, but when it defaults, that's where it becomes a problem. So from an India perspective, and maybe true for Asia perspective, we have seen very few transactions which are purely IP backed financing. Now, typically banks like, a safety cushion in all their lendings. Now, from an IP perspective, the problem is, how do you get comfortable with the safety cushion? What kind of safety cushions can you provide? So one example which we have seen, or one bare minimum sort of requirement we have seen for the banks, is to look at a consistent level of cash flows in the company. Because if you look at the IP assets, again, IP may not be the only asset contributing to the cash flows in the business, but if you look at the business overall cash flows, maybe there is better comfort sitting for the banks that there is IP as a collateral and there are cash flows to service it, and that is how they get comfortable in providing the loan. The other part is on LTV ratio, which is loan to value ratio. Now, typically in the past, when you looked at fixed assets, I think the LTV ratio can be 1:1. Basically, you're taking $100 loan on $100 of assets, or maybe $180 loan on $100 assets. But when it comes to IPs or intangibles, actually the ratio widens to 1:2, or even 1:3. We have seen, again, because of the same ratio, that the realizable value, the collateral, could be very different, when they actually try and enforce that security. And finally, one of the most important parts is about the presence of pirated and fake products. Now, from an Indian markets perspective, we have seen there've always been tough competition from local players, and there are numerous occasions where pirated products come in. They try and use a similar color logo, maybe with different sort of words in it, right? So the spelling of the logo might be different, but the logo colors and shape might be similar. And we have seen these examples multiple times, which actually creates challenges for the innovator, for the IP owner company. The other part of the story is, how do we enforce the IP collaterals? Now, your IP might be registered, it might be licensed, you might have a trademark, which is there, you might have a patent, but at the end, when there is infringement, one needs to one needs effective implementation in a very short period of time to really enforce to protect the value and enforce your rights. And that is where I think if the regulations and the setup takes time, it's very difficult, for the banks to get that comfort. Having said that, I think this is one field which is right up there on the agendas of all the major banks. We've got involved in looking at IP portfolios, especially in the technology industry, in the pharma industry, where banks have got comfortable looking at a portfolio of brands, portfolio of patents, and then also look at the overall cash flows in the company to give loans, traditional loans. Finally, there is venture debt. I think we talked about it briefly earlier, that how the early stage and startups are actually using venture debt. This is one case study of Sito Mobile, where they signed about $11 million deal, where about $10 million was raised through venture debt. And the credit facility was secured against their portfolio of patents, which was around inclusion of automatic provisioning of abbreviated dialing codes. I mean, that is a kind of patents, very exotic, on which they got this funding. And of course, as soon as they got this funding, they were able to take their business growth to the next level. Finally, moving on to the last section, there I wanted to show certain case studies which I think are relevant for today, where businesses have used IP portfolio to survive, to grow, and also expand their horizon with the underlying IP. Now, one of the classic case studies is Eastman Kodak. This is, of course, I'm sure all of you would remember the cameras, the Kodak cameras, which we used to have before mobiles came in, and they completely changed the game overnight. So Kodak was one company which used to believe in strong R&D. And by 2012, it had accumulated 22,000 patents and covering over 160 countries. I mean, look at the size and the length and breadth of their portfolio. However, sales were declining, especially the traditional camera sales and the digital and the print, the traditional prints, which the demand was falling, and they filed for bankruptcy. Now, they were trying to hope to come out of bankruptcy by selling a part of their IP portfolio for $2.5 billion. However, there wasn't much time, and they ended up selling that portfolio of 1,100 patents for almost 1/5 of the price, which is $525 million. However, after they sold it, the Kodak CEO at that time used it to repay a part of the loan, to satisfy certain conditions for a new financing facility, and then position it for certain products for future growth. However, the company still could not come out of the bankruptcy immediately, and they ended up selling a part of the photographic film and paper business, and also a digital printing kiosk to another spin-off entity. And finally, in September 13, it exited bankruptcy. So while it went through its own struggles, I would say, but given the kind of patent portfolio it had and the use of those patents, it was finally able to survive that period and come out of it. The other case study I have is more on a growth side, which is Nokia's merger with Alcatel-Lucent. Now, both these giants merged somewhere around mid 15, and finally, the merged entity was known as Nokia Corporation. Now, Nokia used to hold very high quality patents in the mobile network. You know, you have GSM, you have 3G, you have 4G, and it tried offloading. It actually offloaded its devices division to Microsoft in 13-14. But the good thing is they held on to their patents. Now, when they held on to the patents, there was very good synergies which they found with Alcatel-Lucent, because once they merged, they actually became the second largest mobile equipment manufacturer in the world. And both these organizations together held 29,000 patents, which actually they used to secure a loan of $2.1 billion at that time.
5 minutes, Azral.
So sorry.
It's sorry, 5 minutes to 2 minutes. Sorry,
Yep.
2 minutes.
I'm just ending. I think I'm just on
Sure.
the last couple
Thank
of
you.
slides. Yes, thank you. Okay, and that allowed these companies, while the companies themselves were facing huge competition in the telecom market. All of us know how some of the large giants actually started crumbling when the telecom prices started going south, but the companies then eventually survived and moved back to the growth path. Final example which I have is a more recent example where Reliance Industries, it's one of the largest corporate groups, industrial groups in India. They've been expanding very aggressively in the retail market in the consumer space. They've set up a joint venture with US-based Iconics brand group, and they've been acquiring a portfolio of intellectual property rights of brands and trademarks, which they are using it for expanding their retail portfolio. So one of the recent transactions which have taken place is for Lee Cooper, where they acquired the rights to this famous British denim wear last year. And now, if we look at their portfolio, they actually have almost 24 fashion brands in this portfolio, all from acquisitions. Reliance never had its own consumer or retail sort of a brand. All they've kept on acquiring different brands from different players, including Ed Hardy. So in a conclusion, what we have seen is, there is super recognition, there's super leverage of IP assets over time. The investment in the IP assets have allowed businesses, to make it as a part of their core growth strategy. And that is what today's environment is about. And it has also helped businesses attract venture capital and private equity investments, apart from increasingly being used or being seen as viable assets for traditional banks. And in a conclusion, what we also try to cover, it's very important to understand the value of the IP and also its utilization in the business, for financings and transactions to take place. So with this, I would like to end my session and, open for questions if there are any.
Let me give the audience a bit of a overview about what has been covered. We are covering the financing of the IP and the development of the IP financing in Asia and India. Also global, because some of the good examples are given on a global level. Also the role of IP assets in the business and some case study examples. Needless to say, this is a good opportunity for the entire ASEAN, because ASEAN region is one of the global region where there is an active investment into technology-driven companies, which have a lot of IP portfolios. For now, I think we are holding off the questions because we're going to put it into the panel discussion at the end of the presentation. Allow me to transition to the second speaker, Dato Lau, maybe we can put up the CV. Yes. Dato Lau has been 35 years of services in the area of valuation and property in the Ministry of Finance in Malaysia. Currently, she is the chairman of Ian Scott International. It's an integrated valuation service provider, educated in the MBA in real estate in University of Western Australia, and also a bachelor in survey from University Technology of Malaysia. Needless to say, she has a deep experience in the area of survey and also in the intellectual property. She's going to walk us through her presentation on the financing your IP rights, the perspective of the valuers. Without further ado, I would like to invite Dato Lau. The screen is yours.
Thank you, Pak Truno, the moderator, and thank you to MAPI for this invitation to share my little knowledge on IP with the audience. Good day to everybody, wherever you are. But if you're in the ASEAN region, I think it's okay to say selamat pagi, selamat sore, ciao sang hao, or namaste, I think is still fine for the Indian sector. Right, so my presentation this morning in relation to the IP valuation of financing, it will be the financing your IP rights from a valuer's perspective, because I originated as a real estate valuer, and I have actually gone on, move on forward to the IP perspective of valuation. So for that, we will include the following matters. Can you change the slide, please? I need the, yeah. So what I'll be sharing with you this morning basically are three main sectors: the value creation of IP, monetization of IP rights, and the value maintenance of IP rights. So value creation, I think some historical background was already afforded by Pak Firman in his opening speech. And the monetization part, a lot of examples were given by our first speaker, Mr. Aviral, but we can look into the valuer's perspective. And then the very final one is, if you have an IP, then how do you maintain it? So basically, there are three colored emoticons, so you'll be guided when I go along the presentation. So the very first one, next please. Yeah, the very first one is value creation. So a lot of people are still kind of like confused as to where is my IP. So on this slide, you can see that in the current asset classification of a business, there are basically three classes of assets. The very basic one, of course, you must have the monetary assets, which will be actually cash, your inventories, as well as your stocks. And the second one will be the tangible assets, and in accounting term, it is called PPEs, your plant, properties, and equipment. And the first type, the monetary and the tangible assets, are common in most business doings, especially the monetary assets. You have to start with money right from the very beginning. The tangible assets is the extent that you have may vary with the businesses. Then, of course, there is the intangible assets. The intangible assets is where there is kind of a lot of question as to, you know, where it comes from. So if we look at the World Trade Institute kind of breaking up again as to what is intangible assets, then the there are actually 4 categories of intangible assets, or IA. First, there's the contractual rights, the rights rights arising from contracts. For instance, your employment contract, your services contract, and also goods and supply of goods and purchases of services. All those contracts have a value. And there is the non-contractual arrangements. This one, a lot of time is actually built up due to a long-term relationship between the provider and the benefactor of the service. So very often it is called goodwill, but in actually IP valuation, this is not goodwill, it's a non-contractual arrangements. Non-contractual arrangements has a value in the sense that especially in time of emergency, you are able to acquire certain services or goods to supplement your business to go forward. And what is usually called the goodwill is actually the undefined intangibles. So if you have a value in your financial statement, usually that cannot be attributed to any of the classes that I've spoken, then very often it is classified under an item called goodwill. And this is actually the undefined intangibles. Now, then comes the intellectual property, very often is called IP. So what is IP actually? IP, there are ways that you can identify to say that you have an IP. First of all, is it separable and does it have legal rights? So I give you an example. In the business of shoemaking, the designing of the shoes, the manufacturing of the shoes, and the distribution and the sales of the shoes, and of course the shoe brand, those are all separate entities, and it can be partitioned to different parties, and from there you can identify the different rights and acquire different business values from there. And the test is whether this item can be transacted. So what is meant is that can you lease it, out license or in license this IP, or can you sales or sell off this property as the earlier examples that were given. Then of course there are also cases of donations. If you have certain rights, you can donate, like DuPont and University of Pennsylvania. There are some DuPont rights that have been donated to the university. And of course, IP rights can also be bequeathed in a will. Okay, so if a person or owner passes on and the will is stated that certain IP rights goes to certain beneficiary, then the person would derive the income from the particular right. Now, in the financial sector, the test is fairly similar. There are basically 3 attributes. First, whether it's identifiable, as I mentioned earlier on. Then it must be controlled by the owner, and it has a future economic value. Right, so slightly different kind of identification, but basically it tells you how to identify an IP. Of all the 4 categories of intangible assets, IP is the most recognizable because it has the rights. It has rights, legal rights that you can kind of pull it out and say, yeah, this is the item, this is the brand, this is the license to manufacture, yeah, this is the license to design the shoes. So it is identifiable, is most recognized in that sense because of the legal rights that you can derive from IPs. So IAs, intangible assets, generally they just mean that assets that are non-monetary, yeah, and they are non-physical, but basically all the four categories of IAs, you can derive rights, and these rights do have economic values. Yeah, so I hope that gives some clearance or insight into what is IA and what is IP, which is slightly different in nature, right? So we go on to the next slide, please. So the question is, do you have an IP and did you create a right to your IP? Now, what IP generally means is actually ideas that have been transformed into forms, and it will be able to generate economic or commercial value. So that is the general classification of IP. Wherever you look, the definition is about the same. So there must be an idea, but bear in mind, these ideas must be transferred into forms. Yeah. So then these forms should be able to generate commercial values. And you, from this IP, did you create a monopolistic rights over it? So there are basically 9 types of IPs. The commonly known things like copyright, patent, trademarks, and industrial designs, which we hear of very often. Of course, there are also the lesser known IPs, and these include utility innovation, layout design of integrated circuits, geographical indication, plant variety, and confidential information. But actually, I would like to add to this list my own classification, that is government-based IP rights. That to me, certain certifications by the government do have commercial value. So I take, for instance, the halal certification in Malaysia. I think this is common in Indonesia as well. The halal certification will ensure that your market of that particular product is also open up to the Muslim sector. So it's a wider perspective of market place already. So I actually would like to add the government-based IP rights as well. So now we talk about how do you protect your IP rights? There are several ways. Actually, some IP rights are already protected by common laws. You do not need to register, but you can have an option of registering, but you need not register. For instance, copyright, yeah, and trademarks, you do not need to register, but it can be recognized automatically. But once you register, it means that the registration is only limited to a certain jurisdiction. It is what we call territorial, meaning your protection, if you register in Malaysia, is only registered in Malaysia. So if that particular brand is taken out to another jurisdiction, another country, and used over there by another party, then you have no legal protection against them. The other thing about registration is actually you're telling the world what you have. So this is the case of having trolls who may be looking at what you are creating, and before you can have the registration finalized, they may have copied it and used it somewhere else. So disclosures is actually a problem when you register your rights. And registration also means that it is only limited to a certain class file. For the RISM, the SR or surveyor is a registered trademark. Yeah, but it is only registered in Malaysia. So any other jurisdiction, for instance, like Hong Kong and Sri Lanka, If they were to use it, then they are not infringing on the SR trademark. So we go on to the next slide, please. Yeah. So the next question is, you have the IP rights. How do you monetize them? So bear in mind that when we talk about financing IP rights, end of the day, we are actually looking at the business value that is created by the IP itself. It is not just the IP itself that can kind of like generate the value, but the value when, for instance, a certain brand is put into a business and that business becomes vibrant because of the recognition of the brand. So it is the business that is being valued. So value creation actually relates very much to the creation of value due to your very particular IP rights. So all the monopolistic rights, if they are protected either by common laws or by legislations, they can be used in commerce. But bear in mind that for the example that were given by the first speaker earlier on, you can see that actually certain companies, they have lots of IP rights, but we also must bear in mind that sometimes one particular item can have several IP rights. For instance, your handphone, you have the brand, and then you have the IT technologies, you have the industrial design, you have the layout of the integrated circuits. So all these are separate IPs, and all these should be separately legislated, especially the patent rights, to derive the value. So the bundle of rights from this particular example, the handphones, you ensure that they are well recognized legally. Yeah, so that is where you can derive the money. So let's go on to the next one. Next slide, please. So this example is very much like what was shared by the first speaker. So this data is actually derived from Ocean Tomo, is a lawyer firm in US. They have compiled a 10-year series of the capital values or the market values that have been traded, and they have partitioned it into intangible asset value and tangible asset values. So as shown earlier on, over the last 45 to 50 years, that the values of the market cap derived from the tangible and intangible assets is now inversely proportional. So in 75, 17% was derived from intangible assets, and now 2020, 90% is derived from intangible assets. Now, these traded transactions, they are actually derived from businesses in the US, basically, and some from the European sector. So there are none from the Asian sector. So it just shows that over in the West, IP is well recognized. IP or IAs are well recognized. Now, just talking about percentage sometimes doesn't make any sense. Let's have a look on the right-hand side. There's the 2015 data. So the total market cap actually is USD 18.8 trillion. Yes, and of that, 84% is intangible assets. That is 16 trillion was attributed to intangible assets. And the most prominent IP in this case is actually brand value. Of the 16 trillion USD, 25% actually comes from brand value. So brand value is like us having a name to ourselves. If we have a name and people call, hey, hello, so-and-so. So someone will know that that is you. So having a brand value will identify the particular product or services to you. So brand value is so very important in today's world. So let's go to the next slide and have a look at what is brand value as has been captured. So there are, I have listed here 10 companies that have, noted down their brand values. And you can see that the brand values have actually grown a lot, especially for the technology-based industries. So you get Apple, Google, Microsoft, Samsung, Amazon. Those brand values have really propelled their business forward. So it's just like, what is your handphone? Is an Apple, that kind of thing, you see. So recognizing a brand is very important for a particular business as well. So maybe when you go back, you would like to ask whether your particular service has a brand to the industry that may be able to propel your business forward as well. Right, so we go on to the next slide. All right, so now the next one is about the monetization, which actually we had actually entered earlier on. Monetization actually was also quite well covered by our first speaker, but let's have a look again. To me, there are two classes of financing. There is the traditional, that's what we call, in the banking sector. If you ask in Malaysia, the banks are very, the commercial banks, they are very risk adverse. So I have not come across cases whereby IPs by itself is monetized by the bank giving a loan to them. Yeah, so it is practically, I would say that it's not in existence over here. Yeah, so maybe in the more established market like the US, this is possible. Then we have a look at the non-traditional ways of financing the IP business. First of all, you have the grants. Grants usually are provided by the government sector. In Malaysia, there are several grants provided by the Ministry of Finance. So we have things like Cradle, Platform, and Teraju Superb. Those are grants. Those are grants to you. But in the universities, there are also a lot of research grants that are available to their researchers. Then we have what you call the accelerator funds. Now the accelerators, they actually will provide funding more in the sense of training program. 3 or 4 months training program to young companies, startups, so that they can jumpstart their business, teach them how to do their business, and how to perhaps raise fund as they go along. But the thing is that they do require an 8% ROI on whatever they invest on you. The good thing is that they do not come and participate in your management. Yeah, they only provide mentoring, but they do not come into your management to say that they want to have a say. So that goes on to the next one, angel capital. Angel capital also do not, they provide mentoring, they do not come into your management, but angel capitalists, they will provide funding for a return of 20 to 25%. Yeah, so these angel capitalists, they normally don't come in at the very initial part, but when the business is slightly taken off. Then we have the venture capitalists. The venture capitalists have very high risk appetite, and they will want a share in your equity. and they also would want a 25 to 35% return on their investment. So there are many venture capitalists just in Malaysia as well as in the Asian sector. So they are able to provide the funding, but there has to be a very, you have to pitch for it. It is not like given to you. Then out licensing or in licensing is also a way of funding. Out licensing is where you rent out your IP to another agency and they pay you a royalty. But that is kind of very constant income, and it kind of is an income stream, but you don't get a lump sum for you to kind of like venture out in a very strong momentum. Then in licensing is also a way of pushing up your business. You do not have that particular IP, you license it from another agency, and from there you can boost up your business revenue. M&A is or joint venture is another way. That means you take in partners, yeah, who will also put in some funding into your business. And if your IP has generated into a business that is really very forthcoming, then you can also look into IPOs, that's listing into the capital market. There are people who ask me whether crowdfunding can be one way or not. So that is food for thought. Okay, we go on to the next slide. Now, the monetization of an IP rights, that is when we look at the investors that are coming to put in fund into your companies, we always say the value is in the eyes of the beholder. What does the investor see in your company is what he will put into your company. So for that, it is actually advisable to have a professional opinion of the fair value of the IP rights, meaning get IP valuer to come on board to help you to determine what is your IP right value, so that the beholder will be convinced, right? So we go on to the next slide. Now, the fair value determination, this is just a bit on the valuation part. It very much determine the stages of the business life actually determines the approaches and methods of valuation. Yeah. So basically, there are 7 stages of business life, and it starts with the seed, the very, very conception of the ideas. And then you have a little company, a startup, and then you grow your business. And when it becomes established, you can expand. But when you talk about IP rights, after you have expanded, it might decline. In valuation, actually, when you are valuing a business, you always presume that the business is in perpetuity. And the business will go on and on, but it will terminate at a point in time when nobody knows when. So that is business valuation. But when you tie up with the IP rights, the IP rights
excuse
will
me, 3
have,
minutes to go. Thank you.
the IP rights may.
Sorry, Datolo, 3 minutes to go. Thank you. Yeah.
Okay. The IP rights may be of a shorter period. For instance, if you have an patent rights, the patent right for the IT, for the product that's generated by the IP may only last you about 3 to 5 years, the economic life. But the patent life actually itself is 20 years. So there is the question of legal life and the question of economic life. So At the onstart, if you are at the startup or the seed stage, usually is the cost method, depreciated cost method. But as you grow the business and values are coming in, you have flows, then the income approach is very much the employed. Then you ask, what about the market approach? Yes, the market approach sometimes is used, but usually is used as a double check for the business. Okay, then we go on to the next slide. So for this slide, I'm tying up the sources of finance, that is, who are your beholders, and the stages of a business growth. As the business expands, the value actually also expands. So the capital structure will differ. The equity and the debt will differ as you grow. As on the bullet number 5, you can see that actually you have new markets and products. That is where you can go for IPO, but it will mean that you have more shareholders and your equity part actually may increase in that sense. But at the very first stage, when you are at number 1, usually the money comes up from your own pocket. That's what people say. Nobody, you have not convinced anybody, where your business is going to take you. So the accelerators, the angel, and the grant usually comes in around 2. Yeah, when there's proof of concept. But when there's a proof of value, then the VCs will be quite interested. Yeah, commercial banks possibly around 4 when you are able to commercialize for quite a while. Okay, next slide. So in all businesses, you have to make sure that you mitigate your risk, because value and risk, they are improportionate to each other, inversely proportionate. So there are 2 types of risk. The systemic risk arising from the system is rather difficult for you to control, more so if you are going to have cross-border investment of your IP rights. But the unsystemic risk that is arising from your own business itself, that is where you can actually mitigate and have control. Yeah. So, okay, we go on to the next one. So another way of mitigation of risk, especially when you have an IP rights, you have to ensure that you protect your IP. This is usually the filing part, where you file your IP rights to claim that you have a monopolistic right over that IP. And make sure that you have contracts to show whatever you are doing and not just verbal. And at every process, actually, you have to sign an NDA. And always carry out an IP audit to check on the integrity of your IP right from the very beginning and as you go along. More so if you have to renew your IP rights. Yeah. And the promotion program is important in the sense that you are actually encouraging the public to come on board and participate in your market. All right. So next. Okay, so as a business operator who is having an IP right, you need to create an IP business plan, how you are going to grow your business, but make sure it is realistic. And all documentation of IP development has to be properly kept, especially things to do with copyrights or trademark. Sometimes these are not registered, but they would like to claim under common law. So you must be able to prove that you have prior ownership to anybody else. And in your plan, you must know or identify who are your potential buyers. If you have invented certain drugs, then who are your pharmaceutical companies that you would like into. So these are the people who can provide the funding for you. All right, next. So this part is about valuation. In all the valuation, it is you suggested that you have to provide a valuation report. So you can start with a due diligence checklist, and this you can ask for information that is related to the valuation. And you always remember that all the data and projections, they are provided by the client. You do not create for them. You can have more than one method. Usually it's more than one method of valuation, but when the two values derived are not the same, then you do not average them, but state your reason which is the more applicable value. And make sure that you remember to adjust for part ownership. If you have only 50%, then it's only 50% of the value. And lack of control or lack of marketability, or you have control of market or control of marketability. Those have to be factored at the end of the valuation. But in some jurisdictions, these factors, DLOM and DLOM, they are taken care under risk. So it appears as, in the process of valuation, you have the discount rates. So it appears under there. It's not reflected at the end of the valuation. Now, is a liquidation value recommended? Yes, for business valuation, liquidation value is recommended. But this is on the assumption that the IP is good. The business is going soft because the management is not competent, but the IP is good. So a liquidation value is recommended. So make sure you refer to best practices and be professional in your task. At the end of the day, ask yourself whether your value is defensible, whether it makes sense, when you compare to the market. So report writing, there is no format, no standard format for report writing, but you can refer to ISVS 2019 standard 103. And for value determination, fair value determination, you can refer to IFRS 13. Okay, let's go to next. Okay, so these are some professional bodies that kind of assist you in business valuation, as I've said earlier on. There are no regulators, but they are professional development institutions. So in the UK, you have RICS, IVSC, IASB. But in the US, there are plenty. These are just a few. AI, which is also available in Canada, IACVS, then you have International Institute of Business Valuers, North America, American Society of Appraisers. And in Malaysia, we have MIA, there's the Institute of Accounting, MASB, there's the Board of Accounting, RISM, Royal Institution of Surveyors Malaysia, and we have Business Valuation Association of Malaysia, which is actually the Malaysian chapter of the American IACVS. In Singapore, I think you have SISB. Right, then we go to the next slide. Now, okay. So these are some guidance notes that you may be able to refer to when you carry out your business valuation. For business valuation, you can refer to MFRS, that's the Malaysian Financial Reporting Standards, which is equivalent to the IFRS, the international version. In US, they usually use the GAAP, Generally Accepted Accounting Principles, or IAS, which is also an accounting standards. For intangible asset valuation, look into IVSC 2019 standard 210. And along the way, in the past, IVSC, RICS has also come up with their guidance notes. And in RISM, you can see that on the right, the center one is produced by RISM. That is the Intangible Asset Valuation Guidance Notes produced in 2017 by the IA valuers who are members of RISM. And in Singapore, look in the Part 3 Valuation Standards and Practice Guidelines 2015. For intellectual property valuation, you can refer to WIPO, World IP Organization, MIPO, which is the Malaysian IP Corporation, IPOS, Singapore, SIPOS in China, Sino IP Office, and other jurisdiction as well. I'm just naming a few. RICS, they have the guidance notes 2015. And if you are doing brand valuation, look for ISO 10668. And in 2015, when I was still with the government, I produced a glossary of keywords for IP valuation. There's the book on the top. The book at the bottom is the one produced by the Malaysian Corporation of IP. Yeah, okay, next.
My apology, Dato. I think in the interest of time, we need to wrap up now. If you can wrap up the last two slides.
I only have two slides.
Thank you.
Okay. This is the last emoticon, and it only has one slide. So remember that when you have an IP and you created a right over it, it is not the end of the story. Always take charge of your IP. You make sure you inventorize them, as you have many. Best if you can digitize them, and make sure you have an IP procedure manual. That is how you deal with the IP, the people dealing with the IP in the organization, and how you are going to exploit, meaning you are going to find who are your investors, and how you are going to carry out litigation if there is an infringement. All right, so next we go to the last slide. Next slide. So this is wrapping up. So I had the three emoticons that I mentioned earlier on. So on value creation, I talk about your IP rights and how you monetize them and why you should be monetizing them. And monetization of IP right, talk about stages of business growth and how you, where are the avenues of monetization, some risk factors, and the engagement of a professional IP valuer. The last emoticon is actually about in-house and legal protections of your IP rights and how you want to exploit your IPs. So with that, I go on to the next one. Yeah, so with that, I thank everybody for your ears and eyes, I hope. And I thank the organizer again for the invitation. So back to Pak Triono. Thank you.
Dato' Lau for sharing with us the material. I think it's very interesting to see how IP can be created and then IP can be monetized, and finally the systematic maintenance of value of the IP. A couple of things that probably we would be asking during the panel discussion later on is the experience of Malaysia, and of course I think to a certain extent there is a contribution of the governing law, being the common law, have a lot of benefits compared to probably the rest of the region that probably subscribe to a different governing law. We'll talk more about that later on. I think in the interest of time, let's go to the last speaker from Indonesia, last but not least, Pak Budi Martokusumo. He is a partner of RSM Indonesia, an appraisal firm, and then he is also the Senior Managing Director of PT Penasihat Investasi Indonesia, partner in the KJPP Martokusumo Prastyo and Rekan, and also he is currently sitting at the Board of Advisor to the Antam Tbk, one of the prominent Indonesian listed mining companies, and also managing director of the RSM AAJ Associates. Educated at the Oregon University with a master's degree from NYU Stern Business School. Has been actively in the MAPI, the Indonesian Society of Appraisers, also actively contributing to the Indonesian Valuation Standards Committee and Indonesian Investment Advisors. Without further ado, I would like to invite Pak Budi Martokusumo for his presentation. The screen is yours. So, Pak Budi, maybe you are on mute. Can you make sure that your microphone?
Can you see my
yes,
my screen now?
Yes.
Okay, good. Thank you very much, Patriono, and everyone here. Welcome and good afternoon. I'm the last speaker. I've been given 20 minutes to make a presentation. It is such an honor for me to be representing MAPI and KPSP, the Indonesian Standards Board, today to be presenting to you about IP financing in Indonesia. What they call that, let me just begin on this slides. Hopefully it works. All right, so we start. I'm going to approach it slightly differently. I'm going to be talking about specifically Indonesia, as I'm asked to speak only about Indonesia. The legal base for IP in Indonesia is the government, through its agencies, has committed to developing and protecting IP through its various organizations. If you can see here, let me just make this smaller because I can't see myself. In Indonesia, in the past, since 2000, in the past, have already created new laws regarding various IPs. In 2000, they created a regulation for trade secrets, industrial designs. They have made a 2000 regulation on patents, and they have updated that patent in 2016. And again, in end of 2016, for brands and copyrights. So these are the laws that's already existing in Indonesia. As you can see, there's been a lot of complaints, and as I see in presentation of Pak Aviral regarding Indonesian companies infringing on other people's copyrights and patents. Indonesia has been taking very large steps to making sure that doesn't happen, especially with the regulation number 24, 2019, regarding creative economy, which includes IP and IP financing inside. So these are the regulations that has been created by the government to protect what they call the IP in Indonesia. Okay, next slide. Oh shit. Okay. There are regulations that are very, very specific for valuers of IPs or intangibles in Indonesia. First is regulation of 8C5, which is issued by the OJK, which is the Security Exchange Commissions for Indonesia. It specifically details, in extreme details, regulation are not what is allowed and not allowed for a valuer to do for any valuation for the capital market. Second, in the Indonesian Standards Board, SPI 320 regulation regarding intangible valuations. Okay. Both regulations are specifically for intangible, which IP is a part of the intangible valuation. We believe that in KPSPI that there will be a need to create a specific IP and IP financing and IP for collateral valuation regulation in conjunction with OJK, which is the Security Exchange Commission, with BI, which regulates the banks, and other governmental agencies such as LPS, which is the Bank Guarantee Fund. Now, I'm going to go through these very quickly. There's intangible valuation, a short introduction for some of you that may not know it. The SPI definition of intangible asset is a non-monetary asset that is generated itself through its economic property. An intangible asset has no physical substance, but provide right and or economic benefit to its owner. The clear word here is economic benefit. Without it, there is no value. WIPO, as mentioned by Dato' Lau, is defined as intellectual property, specifically a creation of the mind, such as inventions, literary, artistic works, design, symbols, names, and images used in commerce. Now, intellectual property as defined as WIPO is part of the definition of SPI 320 of intangible assets. Now, valuing intangible assets in Indonesia is regulated, as I said, in SPI 320 through MAPI, It can be done in three approaches, which is one, the income approach, the second is the cost approach, and third is the market approach. In the income approach, we use the present value of all the future cash flows. There are methods which are allowed under regulation, which is return relief on royalty, a premium profit calculation, and EEM, which stands for excess earning methods. Each one has own merit, each one has own complexity, and each one requires an assumption that can be very, very complicated and very difficult to be understood by the reader once they receive the document. Second is the cost approach. The cost approach is based on hypothetical cost to replace the what they call the IP or intangible assets. What they call it, the common one is the reproduction cost, and the other one is replacement cost. Apologies for the misspelling there. Market approach is the third one, which is based on comparable asset transaction multiples. As data are not very difficult to find in Indonesia and are not available, it is very difficult for us to use the market approach other than using comparables from global transaction that has occurred in other countries, which can be sort of what they call that comparable to Indonesia. What we in Indonesia do, usually we use two approach, and we create either a range or a pinpoint average using gross weighted method. Now, for us to say that an intangible asset exists, we must have the following. It must be all or nothing. First, it must be subject to specific identification and recognizable description. If it cannot be identified or recognized, it has no value. It has to be subject to legal existence and protection. There has to be a legal document that says that this exists. It can't be theoretical. There has to be document to say that it exists and it is protected. That is why one of the reasons why the government of Indonesia is so focused on making laws and regulation to protect the IP and the intangible asset is because without protection, the value of the intangible asset becomes worthless. If you make a brand, say brand A, and someone else can use it, and there's no legal protection under the law of the country, that means the value of that asset becomes nothing. Third, it must be subject to right of private ownership, and private ownership should be legally transferable. This is very important because a lot of people ask, what am I about my employees? Are they not my assets? The answer is no. Why? It's not an intangible asset. It's part of goodwill, but it's not a legally transferable asset. Unless you own Ronaldo's contract for playing soccer, you can transfer his contract. But if employees that are not contracted to you cannot be valued separately as an asset. Third, and fourth is coincide with some tangible evidence. There has to be some document. There has to be a registration number, a disket, some what they call it, for example, SOPs, document that says it exists. And it has to be created in an identifiable time. It has to have a start time, and it has to be caused by some event. And the last most important is it has to be subject to being destroyed or terminated of existence and an identifiable time. Every patent, every copyright has a time that starts and it has a time that ends. If it doesn't have an identifiable end time, it is also becomes difficult for the valuer to do a valuation of. Now, the biggest fight for all valuers in doing the valuation of intangible asset is the remaining useful life. An asset has to have an economic life. How long is that economic life? What is that value? Okay. The period of which asset is expected to contribute to future cash flows. Now, if an asset, you have a brand, ABC brand, and that brand does not create any economic value or any future cash flows, it is close to impossible for us as a valuer to do a valuation on that. The next one is determination of the rule, remaining useful life based on analysis. That's the second method. Now we need to analyze the expected use of the asset by the acquirer and target. Say a large company that has a very strong brand buys another company that's has the same product but a weaker brand. Are they going to keep that brand? Are they going to keep it running? As a market price, yes, you have to assume that they exist because then that a buyer would use that brand. Okay, so there's a question. But however, if the company is going to not utilize that brand actually just to kill the brand, the valuer might have to say there is no value, or that value has now been depleted. This next one is the expected useful life of another asset or group of assets to which the useful life or the intangible asset may relate. Simplicity, how to explain this. For example, AS400 computers from IBM, it changes every 4 to 5 years. Every 4 to 5 years, they upgrade their whole system and they hold the whole hardware. Therefore, you need to reinvest and work on the new hardware platform. Now, if you are valuing a software that works on an AS400 platform from IBM, you have to assume that every 5 years, you need to do a huge capex. And therefore, the expected life is the turn of that product or the hardware that utilize that software. The next is legal, regulatory, and contractual provision. Legally, a patent has an end date. Even a brand has an end date. It can be extendable, but us as a valuer, we must only allowed to do the valuation to the contractual end of that remaining useful life. The next is effect of physical deterioration, functional obsolescence, technological obsolescence, and economic obsolescence. Now, these days, technology changes so fast. If you imagine, for some of us who's been around for long enough, when we were young, we did not have a handphone. Then we had a Nokia, Ericsson, small handphones. Then we are now moving on to the smartphones. Now imagine if you are making an SMS system for distributing. It can be utilized now in the smart telecom platform, but it is very rarely used. Even WhatsApp, or even the most famous one is BlackBerry. BlackBerry used to be worth billions of dollars, but today it's not very much worth. Because why? Everyone has moved on to either Telegram, WhatsApp, or Facebook Messenger. Level of maintenance expenditures required to obtain the expected future cash flow. Some software, if we're doing valuation of software, every few years needs to be upgraded. And there's not small upgrades. We're talking about huge upgrades. If you imagine, just a few years ago, we had Android 1. We're now to an Android 11. Soon will be 12, 13. Some software that works on Android 11, works on Android 1, no longer works in Android 11. So you have to see how long is the turnaround time wherein your technology becomes, as they say, no longer useful or can be changed. And if it does, it requires a lot of capex. And therefore, there could be a valuation that ends before the next capex run is acquired, because the capex may actually be bigger than the actual value of the intangible asset. And the last one is the estimation of future benefit derived from the technology. Now, what is the IP financing reality in Indonesia? I am only allowed to do this for 20 minutes, so I'm going to do this very fast. Come on, change slides with me. Okay. Now, I don't have a lot of slides, so I'm going to do this very quickly. Why IP financing through banks are not successfully growing in Indonesia? This is my opinion, and we've been doing a lot of intangible valuation in my appraisal firms. First is the lack of technical framework being derived from Undang-Undang Law number 24, 2019. It is not specifically designed for IP financing. There is no clear law for the banks to see that they are allowed to do IP financing. Now, intangible financing is a different story. Contractual agreements using factoring, using securitization is common in banks, but it's not IP. You can't have a library of film or a library of books that can be easily funded by the banks. Second is collateral valuation is complicated to understand, and assumptions can be difficult to be understood by the banks and the financial institutions. When you do collateral valuation of a library of films, it is very difficult to explain to the banks how that cash flow of that library of film can be created so that they can have the cash flow to pay the interest and potential principal into the future. In Indonesia today, now in other countries, they have specifically film financing departments in banks, and music financing department in banks in other countries. But in Indonesia, it is very rare and extremely uncommon. But hopefully in the future, it will become more common. The next is that no guarantees from agencies like in Malaysia and Singapore. From what I understand, there were programs in Malaysia and Singapore to attract banks by providing either guarantees or support for IP financing. Now, there are no in this group today in attendance. There are governmental agencies. Maybe you need to take a look at that in other countries which have been successful. But however, even in Malaysia and in Singapore, when those what they call it incentives from the agencies of the government was removed, the number of IP financing dropped in line. And in addition, the reason also is that IPs, some of the IPs, actually most of the IPs, are depleting assets. It has a time when the remaining useful life becomes shorter and shorter. And as IPs get depleted in its value, banks are holding on to collateral that is decreasing in value, may not be matching with the loan that they still carry in their books. Now, taking into consideration, I think Abiral here and myself, we specialize in restructuring. Myself, I did over 100 restructuring at the Indonesian Bank Restructuring Agency. If the IP is depleted, by the time the bank is trying to acquire the IP to somehow monetize that IP by selling the IP or finding an investor to the IP, that IP, the remaining useful life, may be too short or maybe too close to its end, that the value becomes very minimal. And therefore, in other words, banks do not like assets that deplete in its value. They like assets that increase. Now, for example, painting and books and things, if you have some of the assets go up, but very rarely they do. Most of them just go down as the market have read the books or markets have listened to the music and they're moved on to the next music line. The next one is very difficult to unload and sell into the market. Now, banks love to have collaterals like buildings that they can find buyers for. They can have a large pool of buyers. IP's buyers are very limited. There are very few users of that specific IP that is being secured by the banks. The next one is large price gaps. The valuer may value it at 100 based on cash flow. However, the new buyer may value it at 20. The price gaps is significant. It is very difficult to get a grip for the bank of what is the real value if I liquidate these assets. The next one is price linked to the developer and the creators. Some IPs are just linked to a specific creator or a specific developer or a specific company. You might buy a brand, get a brand like Indomie, but you have the which is made by Indofood. You have that brand and the bank secures it. And if that brand defaults, who can they sell the brand Indomie to? Not very many people, only other noodle manufacturers. Say so it is, but it is linked. Some of the IP is linked to other IPs which is not secured. For example, the brand is secured, but the product design or the product trade secrets are not linked to that. Are not part of the security documentation. So you can have the brand, but you don't have the trade secret. You can be selling the brand, but you don't know how to make it. So that also increases the complexity. In Indonesia, most banks prefer fixed asset that they can value. The next one, of course, is very important because banks, like everyone else, is audited. And the auditors analyze assets under collateral as risk. Fixed asset risk is relatively small. However, intangible risk is very high. And therefore, because they have a higher risk of their collateral, there is a possibility that the auditors will require additional reserves for the bank, which is a cost and hurts the P&L. The next one is the high risk of asset to totally become valueless. The idea is that, as I said earlier, it is an depleting asset. For example, today in this, for example, for Indonesia, the Holy Wings example. Holy Wings is actually a chain of bars in Indonesia that got into a bit of a trouble in the past 2-3 months. What happens is their brand used to be very, very strong. They were opening bars in many cities, in many locations throughout Jakarta. And it was always a very, very, what they call it, hotspot. I don't know this, my daughters and my tell me. It's a very nice hotspot, it was full, and the income was coming in very, very strong. However, due to one transgression with the law, the Holy Wings brand, the Holy Wings license has been revoked by the government. Now, imagine if you're a bank that took the IP Holy Wings brand as a security. There is a third party that can revoke that license. So therefore, for our local banks, for the, as they say, traditional banks, IP financing will continue to be something that they steer away from and focus back into the fixed asset collaterals. Now, I promise this is my last slide, I think. Yes, it's my last slide. There are some IP financing for non-banks. Now, from my knowledge, there's very few direct IP financing through non-banks. However, indirect financing are done through the following. I've seen it myself, which is the VC structure, wherein they come in either through a direct share ownership, where they come in and they work with the management, not on a tutoring level, but actually sitting in the management, and helping the company in Indonesia that has an IP to grow. For example, Halodoc, so many others, startups, medium-sized startups that have already begun to take off where the VCs come. As Dato' Lau said, there are stages at which IP financing works. In the beginning, you use your own money, then you use your friend's money. Then once you've run out of that, you begin to go out into the finding in investors. Now, the first investors that usually come are either angel investors, which sometimes a lot of people call devil investors because they're actually using their own money and they can get really, really angry if it doesn't work out. So, sorry, that's
2 minutes to go, Pak.
Yes, I know, I get it, exactly. And the next one is convertible bonds. And this is very common for tax purposes and for control purposes. Some industry in Indonesia are protected by the Indonesian government, as foreign investors are not allowed to enter it. They come in through convertible bonds, and they will come in to they will convert into shares and monetize their IP investments or IP loans through IPO. The next one is crowdfunding. There's a company in Indonesia that's very big called Investri. They do a lot of IP financing through crowd investments. And the last one is the IPO. There's two that's already been successful, which is GoTo and Bukalapak. And I think that's my presentation, as I'm only allowed to talk 20 minutes. Patriono, the table is yours. Thank you.
Thank you very much, Pak Budi.
Yes, Pak.
Very, very good exploration of the IP financing in Indonesia. It's a good, a little bit detailed, but it's very good giving us the extent of the issues and the challenges and the potential opportunities for IP financing in Indonesia. The next one, I think we can go into the panel discussion. My question will be, this is the question from the audience as well as from the organizing committee. We put together some questions. I think first, the question will center around two areas. First, of course, on the valuation side, and of course, on the financing side, which is in line with the topic of the webinar today. In summary, the question around the valuation side is on the nature of the IP. For lack of a better word, the IP behaves like a call option or a real option, if I may call it correctly. Technically correctly, it's like a real option. It may be valuable contingent upon certain situation, in this case, because most of the IP are internally generated IPs. Call option, although technically correct, probably very difficult to harness into the valuation practice. Probably let me ask this to the audience here on the challenges and what would be your suggestion to value internally generated IPs which behaves like a call option or behaves like a real options. the value of which would depend upon a lot of other factors. And it is, of course, you need to plow it into the business and generate cash flow to value that. Maybe let me ask first to Aviral. Do you have any ideas on this question?
Thank you. Actually, the internally generated intangibles are very, very difficult to recognize. Of course, valuation is an art, it's subjective, whether it's internally generated intangible or externally generated. But more importantly, I think what we've seen in the past, if let's say a company is acquiring a certain set of intangibles or a certain IP, there is a transaction backing that value, that price at which the transaction took place. And 9 or 10 times, assuming it's a arm's length transactions, right? There are two parties, willing buyer, willing seller, selling a particular asset that at least gives a certain benchmark of the value of that IP asset. Now, these advantages are not there for internally generated intangibles. So, for example, a company continues to invest in its own brand and they keep spending a lot every year on marketing and selling expenditure, but it is nowhere recognized in the balance sheet, right? The company keeps expensing these items year after year, and there is no way to really recognize the intangible which is getting created. Similarly, we have seen a lot of expenditure being done on the internal IPR&D projects. Technology companies, research companies, they have a large budget on these expenditure. I can't comment on the accounting laws prevalent in Southeast Asia, but let's say in India, it allows companies to get certain additional tax benefits on the R&D expenditure, and perhaps to the extent when the IP, till the time the IP is getting put to use, they can recognize this under CWIP, under work in progress asset. But as soon as the IP gets developed, then again, it's expensed out. So accounting standards, unfortunately, do not, help in carrying out, help in valuing these internally generated intangibles. However, coming back to your original part of the question, which is the valuation, I think the valuation techniques will remain appropriate in the sense of, I think some of the panelists did mention what are the various valuation techniques, whether you look at a variation of income approach. Within income approach, for example, we have relief from royalty method, we have multi-period excess earnings method, we have premium profit method. Then we have a certain market approaches where we look at transactions, we look at certain other royalty rate transactions or a transaction of an IP. Seldom we find very equivalent IPs. And third is a cost approach where we look at from a replacement cost perspective. What is the cost required to rebuild that asset? So these are the approaches we'll apply, to value the intangibles and the IPs per se.
Have any say about the internally generated intangibles, which are valuable but very difficult to value? Any idea on the tips to the appraisers here?
Well, Avril has actually put everything in the correct perspective as far as internally generated IPs are concerned. They are not recognized in the financial statements of that particular business. However, when it comes to valuation, once it's generated and kind of producing an income stream, that particular income stream from that particular IP can be identified usually by the business and call for a valuation. So internally generated IPs are not recognized in the financial statements. But I think that's the general practice because most of us are also looking at into the international financial reporting standards. But when it comes to evaluation, Well, it's also like Mr. Avery has said, there are so many methods, so many approaches and so many methods. Of course, because a lot of these IPs are actually valued for commercial uses, so the income approach is the most prevalent approach used. And of course, the income approach itself has several other methods under it. The relief from royalty is much used because a lot of out licensing are also being done. So you have the projected cash flow, which is a question of whether you believe in the future cash flow or not. So there is much caution as a valuer. If you are using the income approach, you make sure that the projected income or the business plan is realistic, and the income is kind of attainable. And there are factors like people say, how do you know that this is going to happen? Well, that actually you have to depend a lot on the business itself, the integrity of the owners, and you have a saving clause called the know and knowable subsequent events. So the valuer will have to qualify himself that he is only valuing based on know and knowable subsequent events. Other than that, it's really
Okay. I think we momentarily we lost Dato. But I think we get the idea. Having to triangulate between different methodology and incorporating what would happen, or the scenarios, what is known or what is knowable at the time. Pak Budi, maybe you have any idea, any suggestion on the valuation of internally generated intangibles?
Yes, as I mentioned earlier, there are three methods we can use, but the market approach is for internally generated, it's a bit more difficult to utilize. I think the easier ones is, as Dato Lau and Mr. Aviral said again, which is the income approach. But the income approach is determined on how long is the remaining useful life of the asset, and how protected is it, and how marketable is it. The company always says, well, we generate this product and everybody wants it. The question, is it a reality? Is it something that people actually want? Is there a demand? So as an evaluator, we do valuation based on historical. So if there is a historical demand for that specific product, and therefore it is easier for us to determine the future income of that specific, whether it's internally generated or whether they do a partnership with others. But internally generated can be anything. It can be process related, which can only be utilized their own process. And there are others such as brands and other products that is internally generated IPs, which can be utilized the income approach. Now, if it is not saleable, then we have to also utilize the replacement cost or reproduction cost. That's another method, Pak Triyono. Thank you.
Let me transition to the next question. I think a lot of audience has been asking about the financing part of it. Aviral have give us a very good examples of David Bowie, a big fan, on how to monetize and how to raise financing based on that. Probably let me ask to the speakers here in terms of the challenges, and especially quite a number of the audience are coming from Indonesia, having been in a continental law environment like Indonesia, inheriting from the previous Dutch administration, while probably Malaysia and Singapore in common law it's more accommodative in the financing part. I think we can learn experience from the securitization back in the days. Maybe we can ask the audience here about the what would be the challenges for the conventional banks to participate in financing the IPs, and probably if probably conventional banks, probably we cannot expect them to be very significant in contributing to the financing. What will be the alternative financing available, and who they might be? Maybe I'll start with Aviral. Maybe you have some idea about this financing challenges, and especially on taking this as a collateral. Go ahead.
Right. Thank you. So from an India perspective, I can give few examples, and which I didn't cover exactly in the slide, but you would have heard of a company called Kingfisher. It was one of the most sought after airline in India, and it was run by a very well-known entrepreneur who was known for his flamboyant lifestyle and interests in fashion and car racing and whatnot, in almost everything exotic in this world. So, but nevertheless, let me come back to the discussion. So this Kingfisher Airline was one of the fastest growing airline. It was one of the most premier airlines in India. In fact, best of the best, I would say. And he was successful in raising a loan, a very large loan. I think if I recall correctly, just under $1 billion against the brand, against the trademark Kingfisher. And the airline was doing very well, but however, two things happened. He became very aggressive in making acquisitions. So he made a very aggressive acquisition of a loss-making competitor, Deccan Airlines at that time. And B, in India, the crude oil and generally speaking, the overall petrol, diesel, and other fuels are highly regulated. So there are tremendous amount of taxes which the government has. So sometimes even the taxes are more than the price itself, the input price itself. That is a kind of situation we used to have. Now, when the crude price went to $90 or $100, that's when the margins became super negative, and suddenly the airline business became the most non-profitable industry at that era. Now, while all these were happening, banks, while they had given a loan, taking that brand as a collateral, suddenly realized that this company is going nowhere. They're not able to service anything. The promoter then, because of regulations and the fear of getting arrested, went to London, and they caught hold of the security collateral, which was brand. Now, 5 years forward, this is almost like a long story. So 5 years forward, maybe a few years back, until then, the bank was trying to sell the Kingfisher trade name, but there were no takers for it. The only thing they were able to exit was some of the hard assets which were there, certain offices of Kingfisher and certain other things, but brand they were not able to sell. Even that was while that was a driving asset. Now, this experience, when the banking sector did open their arms, to lend against an IP, a pure IP, this whole experience shook the banking industry in India, because once you have such a case where public banks have lost such a humongous amount of money, the whole situation becomes political, right? So lately, what we've seen in India, at least, and that's what I tried covering in my slide, the banks look for a lot of safety cushions when they have to lend again in a business which is purely IP-driven business. They look at higher LTVs, loan to value ratios, maybe 1:2, 1:3. They look at a consistent level of cash flows in the reasonable past. Of course, they take a deep dive in projections. And as a best practice, we have seen some of the largest commercial banks like HDFC Bank, ICICI Bank, and other banks, they annually monitor that loan. So for example, even we as a firm get involved in monitoring the loan portfolios which are backed by IP assets as a collateral, may not be the only collateral, but as a additional collateral, and they want a third party opinion on whether the cash flows of the business are doing well, what are the prospects, and are there any triggers, to increase the safety collateral. The other aspect which I've seen in the banks, now they're understanding it. So just by taking a IP as a collateral it's not the end of the game. So they are going in depth. So for example, when the Kingfisher trademark was taken, it was specifically for one purpose, and that was aviation. Now today we have the same trademark being used for F&B, food and beverages segment, but the banks don't have access to that use of the brand, which is getting monetized by the company, by the new owner. They're still monetizing that brand, but the banks don't have access to that. So, so the use of the brand, what sectors are we talking about? What products are we talking about? What geographies are we talking about? What exclusivity rights are we talking about? All these ancillary sort of economic privileges become very important. When banks have to look at these IPs. So these are the few things I thought I'll just add to the ongoing debate, and the debate continues. Even today in India, I'm part of the Committee on Intellectual Property in one of the largest industry associations, CI in India. Even today, all of us together are figuring out how to convince the government, how to convince the banking industry to get back to taking IPs as a direct collateral. But I think we are evolving, but it's going to take some more time.
To Aviral, in the Indian experience, do you have the alternative specialized financial institutions which are more sophisticated than conventional bankers who can work through this kind of specialized structure of financing?
Not yet, I would say. The government has been trying to put together some central scheme, especially on the lines of IPOS, to provide certain guarantees, corporate guarantees, bank guarantees, really, for doing it. But we've not got those breed of institutions, right, or public institutions or private institutions to that extent. However, we have a very large sophisticated, well-developed ecosystem for venture capital and private equity now. India today is home to more than 100 unicorns, and in fact, third largest country in terms of unicorns. And this has happened just over last 3 years, 4 years, with so much funding coming in. Now, what has happened is while companies have not been able to make inroads in traditional sort of banking system with these IP tech companies, they have got a lifeline with these global venture capital and private equity funds. So basically it's an alternative source of financing they need to dilute, but that's done very well. The IPO markets have also been very strong. Of course, the recent crash in the market globally and the multiples going down is kind of a speed breaker, but last couple of years have been phenomenal for the industry. So I would say the industry did not feel the absence of having lack of institutionalized sort of setups for financing IPs. But now with liquidity going down, interest rates going up, capital markets not so rosy as they were 6 months back, now I think is the time when they will feel a need that yes, we need a specialized institution for IPs.
Thank you, Aviral. Let me go to the next panel. Dato, what can we borrow from your observation and the Malaysian experience in terms of the challenges of conventional financing for the IP, and probably whether there is a specialized institution with the proper expertise and ability to structure to address these challenges? I mean, Aviral has mentioned that using the Kingfisher experience, how significant is the nature of contingency. Something can be scalable in an unlimited manner, but suddenly it becomes valueless. Go ahead, Dato.
As I've mentioned earlier on, commercial banks in Malaysia, even though very much encouraged by the Bank Negara of Malaysia, that's the central bank, to afford, liquidity, some form of liquidity on IP assets. They are still very risk adverse. So not that I know of any that had kind of finance and IP. But financing a business that has been built upon an IP, yes. So basically, end of the day is financing a business, but the business may have some IP rights in it. So, but in the Malaysian scenario, maybe the government have been quite encouraging in terms of alternative financing. That's the non-traditional things like, I've mentioned grants. So the government have actually grants under the Science Ministry, Science and Technology Ministry. They do have grants that is afforded for those startups. And these are usually initiative from the Ministry of Finance. So in a way, there is some government support in that sense. However, there are also other forms of government as well as private initiatives in terms of accelerator investors funding. And these are usually, they are supported, some are supported by the government, some are actually private initiatives, but they do not usually come in at the very onset of the business. Is when they see some value in the business before they come in. And of course, there is the angel investors who may have a slightly higher risk appetite, but they do expect a higher return on their ROI. So the angel investors are, like I think Pak Budi just now mentioned, he also calls them the devil investors. I don't want to mention there are quite a few of them in Malaysia, quite a long list of them. So usually they come in as mentors and they do not actually participate in the management. So maybe they are not so devilistic, but they may be devilistic in the sense that the ROI is quite high. 20 to 25% is not a small amount. Yeah. And then, of course, the venture capitalists are plenty in Malaysia as well as in Southeast Asia, I think, and there are so many in America. So the venture capitalists, they are more than giving you the money because they are expecting a high ROI. What they will do is they want to have a share in your management, so they become part owner of your business. And they usually expect 25 to 35% of your ROI, of their investment. So, and the amount of funding that they will give depends on how, what they think of your business, you see, how far you can be going. Yeah, so they may give you as much as 1 million USD or less than 1 million. So depending what they see in your business, is like what I say, beauty is in the eye of the beholder. But there are plenty of VCs around in Malaysia, as well as in Southeast Asia, and like I say, plenty in US. So just that they want a share of the management. So probably they also ask you to form a board, and they would like to have a seat in the board as well. So other forms of funding are quite, I mean, they don't really bring in a lot of cash income stream. It's just like through JV, M&A, or out licensing. Those are just like, you are generating income from your IP, but they don't give you a lump sum of money at the onset. So those few that I have mentioned, they are able to give you a lump sum of money, but they must have trust in your business, and you have, as the owner, you have to ensure that you maintain the integrity of your business, as well as the integrity of your IP. So I have come across one guy who had an IP, and he told me that end of the day, if I go solve in my business, I'm left with my underwear. So that's how challenging it is. Thank you, Patrino.
Ask you a follow-on question in terms of the maturity of them. I think based on your description, Malaysian venture capital industry is quite well developed and they are quite comfortable in financing ventures. But it seems to me that they are more coming from an equity perspective, or maybe a little bit going a little bit higher in terms of priorities, going into maybe mezzanine or subordinated. But how far they are in terms of providing through what they call IP-backed lending or IP-based financing. But from your description, it sounds like more like a cash flow-based financing.
Yeah, it's a cash flow kind of thing. Yeah, and they don't just, depending, especially the VCs, they usually need to have confidence in your future cash flow. They need to see something before they really come in, because they are rich investors though, but they still want to ensure that they are not investing into something that they do not get a good return. So, I mean, nothing is free.
Okay, thank you. Let me pass on to Pak Budi. I love your examples with Holy Wings. I think you are a regular customer there.
Hey!
For those who are not aware of, Holy Wings is recently come into a little bit of an issue with the government on the bar business. Pak Budi, what is your experience in terms of Indonesian banks' comfort level to finance IP as a collateral, and whether you also, in your experience, you are looking into the venture capital willing to lend upon IP in whatever form of security claim or collateral seniority? Go ahead, Pak.
From my experience with dealing with the conventional banks, even the Sharia banks, they always view IP as an additional collateral, as part of the other collateral. They rarely or never take on IP as the major collateral. The collateral that they use is fixed assets, other assets, and IP is part of the bundle of assets that they use as collateral. So they take it into consideration in the value, but they don't take it in its own. I haven't seen one that takes it as its own. Now, as mentioned by Dato, I mean, in Indonesia, we do have lots of local venture capital lending for IP, but not specifically for IP, but the business. Now, however, in Indonesia, there has been in the last year or two, a few issues with one or two venture capital that literally went too far, wherein the people that they invest to are very angry with the private equity. So there are situations right now, especially in the F&B business, wherein one of the biggest private equity that owns probably now maybe 9 or 10 brands they invested in, small brands previously now becoming hundreds of branches, they're having issues with the private equity. So as Dato Lau says, they sit on the management and they push. Sometimes they push too hard to the management. So the answer is yes, there is a lot of funding, but it's never, Patriono, it's never specifically for the IP. So in the old days, maybe about 8 to 10 years ago, if you got a good idea, some venture capital or some, as they say, angel financing might be able to help you build to the next stage. Nowadays, none, and not that I see. You have to have an idea, you have to have your software ready, you have your apps ready, you have to build a proper investment deck, a proper track record for them to be able to become even slightly interested. Usually the angel financings are easier, but as I said earlier, they ask a lot. And the reason why I also say it's devil financing is because sometimes it's your own family. That's what I mean by the Dato. If imagine you borrow money from your uncle, and then the next Lebaran, Idul Adha or Idul Fitri, and you see him and you haven't paid back his loan. That's why I call it the devil's loan. So not only they ask for a lot, but you have to see them and you cannot get away from them. So that's my joke about the angel financing. But there are professional angel financiers, people with very long track record of successful startups they have made in the past. They are helping new guys that are coming in. And I think here, Mempekraf, what they call it, the people from the previously called Bekraf, they are trying to link between the investors and these startups, which is very good, I think. That's my understanding, Patriono.
Let me go to another very popular question is about what happened in the rainy days. So if the business goes south and the bankers have to execute based on their seniority rights to get what they can scrap from the business. And let me go to Aviral. Thank you for your previous example on Kingfisher. What can be done? Are we going to take away their computers, their laptops, or what is normally done in this situation?
Yeah, I think I tried touching upon this that the banks are becoming more knowledgeable, or I would say are more focused in their diligence when they look at the documentation and the rights coming along with that IP portfolio. You know, whether it's got to do with respect to the use of those rights, the life of the asset, then the registrations, your geographic limitations, if any, exclusivity limitations, etc., etc. So, you know, the typical, the full set of economic conditions driving the value of the asset. Number two is making sure that they have an agency to monitor it, because banks are banks. I mean, they're not in the business of running a business, and especially getting into IP, getting into the shoes of a company which has developed an IP and then run a business on that. I mean, banks are not in that business at all. So they need specialized support. One is, of course, the monitoring part of it. And the second part is to figure out, you know, the right time of exits, you know, whether it's, so before the default takes place, if the banks understand that the asset isn't doing well, then what is the right time to figure out a solution, whether you take additional collaterals or you actually try and exit the loan, try and make sure that the business finds some other lender, or do a settlement and just step out. So I think these are a couple of things which we've seen in the past, how banks would get into this. The other thing practically which I've seen, if of course, you know, sometimes these public institutions are so large, they're not able to visualize and project that the stress is coming in. And it's only when you know, the shit hits the fan, that's when they really step in and you know, try and understand what to do. So we have seen lately the banks are having conversations with the competitors, you know, in the same field, in the same industry, and before the brand dies, to check whether they'll be interested in acquiring that. Again, success stories, I would say very few, because competitors relish that moment, right? They know that this brand is going out of distribution. Why should I pay $1? Rather, I'll increase my own spending and increase the dealer incentives to push my product at that time. So it doesn't work. The other aspect which I've seen, which doesn't really you know, is applicable for distress situations, but more on a growth situation side, we have seen emergence of certain platforms, especially D2C platforms. You know, like you have the likes of Mensa brands, and some of the global names are in India now. They are aggregating smaller trademarks, smaller brands, and creating a portfolio out of this 30, 40, 50, 80 brands in their portfolio, maybe those brands are doing $1 million to $5 million sales today. They're investing in them, taking it to the next level, which is 20, 30, 50 million, and finally maybe making exits, at 70, 80, 100 million. Of course, not all of these brands will be successful. So that's another platform which has emerged. And my sense is that if these platforms grow, they will also start getting into the distress side as well, especially for the brands which can be revived, which can be taken to the market in some form or shape. So those are my thoughts. But yes, I think as other panelists and Budhi was mentioning, seldom we see brands getting comfortable with purely IP as a collateral. It's always used as an additional comfort, additional safety cushion. And if they were to do a pure direct collateral, I think the documentation will be quite heavy. Yeah.
Before I move on to Pak Budi as the panel for the same question, seems to me that both Indian experience and Malaysian experience, they both have a good ecosystem of innovators, and also the venture capital industry is quite quickly catching up with the more developed Western venture capital industry. But still, on the financing of the IP, it's still a lot of area to catch up. Let me ask for the Indonesian experience, Pak Budi. What would happen if the IP-based financing goes south and the banks need to execute the collateral? What can be done, and how can we make the bankers quite comfortable if they are interested in participating in this kind of financing?
Okay, so like all banks, all assets in the banking system, if you want to get out of it, you need to go through the auction system. So, or to find a potential other investors to acquire the assets. It is very difficult, but the pool is very small. And as my favorite professor at my university said, as Aviral said earlier, there's nothing better than a dead competitor. So they will dance on the grave. So they say, hey, this brand is gonna die. Would you like to buy the brand? No, or accept if it is a different brand. So there are, you can see in Indonesia, many companies now, what they call multi-branding, like the famous MAPP, Mitra Adi Perkasa. They have like 20 brands. These guys are interested. They might be interested. But again, if they already have a brand in that specific area, I do not think they will be acquiring more brands. But there are companies now in Indonesia, I think about, there's like 4 or 5 that I know of, which is right now acquiring brands. And so if the banks have a default in that area, they might be able to talk to them. But however, a brand in itself is sometimes useless because the brand is good, but you also need to have the trade secret to make the product. Imagine if you own the Kentucky Fried Chicken brand, but you don't know how to cook the Kentucky Fried Chicken. You have a problem. So therefore, sometimes, and as Aviral said, the documentation, if it will occur in Indonesia, will be very complicated. I mean, it has to be a chain of products. So you need to know the trade secrets. You need to know how to make the chicken, and if you and the brand. And if you put this all together, then you have a franchise or you have a business. So in reality, you're not specifically having the IP as a security, but the whole business IP as part of that security. I think it's very difficult for you just to do one IP for one security. And in acceptance for music, maybe music may be different. Say for example, if you can get the library of, sorry, Viral, you might know a gentleman in Indonesia named Krisha. I like Krisha. So it's a very famous Indonesian singer. Now his library may be worth something because he's so good that continuously, potentially into the future, they will not be able to do that. So I think the David Bowie example is very good and potentially can be done in Indonesia. And I want to throw a little bit of a screwdriver into the conversation today, Pak Triono. And I have Aviral here and Dato. What about the last one, which is we haven't discussed, NFT? For me in Indonesia, I do not understand it, but maybe you guys, has India gone through this? Thank you.
Okay, thank you, Pak Budi. Uh, uh, Taking a very tough question. Any thoughts on the blockchain, the NFT? Probably not so much into cryptocurrency, which right now is on the melting territory. But what is the opportunity for us with the NFT technology, where we actually can ensure certain work of art, maybe a digital work of art, can be ensured that it is protected and it is unique, it is original? Would that be something that can be monetized? We are talking here about the IP, which is traditional, like the David Bowie thing, where actually the monetization of David Bowie probably goes as far as subscription model. But let's a good question from Pak Budi about the how to harness the power of the blockchain and NFT, and then using that as an IP for financing. Maybe let me go into Aviral. You have any thoughts on that?
Yeah, I think Budi is already predicting what's going to happen at the in the coming era, so to say. So NFTs have now becoming more common in India. We've seen quite a few celebrities launching their own line of NFTs. You know, what does it mean? I mean, let's say if you have some artistic product, you have images, you have songs, you have some videos, some special moments, you want to use the blockchain technology to ensure that that is the authentic sort of a piece of art, which you can then digitally sell a limited pieces, or control the use and the sales of that art piece. So right now what we are seeing is there are a lot of startups which have come up. So for example, a startup has come up capturing specific cricketing moments. Now cricket is a sport in India which is really everyone follows it. So so they're trying to capture certain old batting shots, which are the most famous shots. For example, they're trying to capture the new upcoming stars. For example, Virat Kohli's or Sachin Tendulkar's. Some of the cricketing stars we have, they're iconic styles of batting and certain shots in key matches. Similarly, you have celebrities doing that, for some of their artwork, Bollywood celebrities, movie celebrities, etc. So we see this ecosystem developing very fast. Now, so right now, most of the financing from a financing perspective is all driven by venture capital and more like a venture financing, whether in form of equity or a pref capital, perhaps venture debt, though I've not seen too many deals, or I might have missed it. But it's growing very fast. Now, what can happen with this is if we are able to collect a good portfolio of these NFTs, and there are certain cash flows, certain royalties, certain recurring consistent level of cash flows associated with it, then finding suitable investors, whether you directly sell them, securitize them, create an SPV, or in whatever form or shape, it's easier to find investors on that side. However, I think a part, you also mentioned blockchain, and one major application of blockchain is cryptocurrency. I think that part of the application has gone through its own situations, volatile situations. I mean, we have seen cryptos going from $1 to $1,000, and then now coming back to maybe $10, not exactly $1, but $10. In fact, last week I got an email from my Singapore office. They have been mandated to resolve an insolvency for a large crypto player which has some presence in India. So there is so much volatility in cryptocurrency that's very difficult to find. I would say patient capital, public financing, large institutions getting involved. It's going to be driven by risky capital, the kind of volatility we have. So maybe a little far away, where we bring into this IP domain from a crypto perspective. But yes, I think NFTs definitely have a future. Even I'm learning, to be honest. I need to first buy an NFT to experience myself. I haven't done it yet. But, once I do that, I think in your next session, I should be in a better position to maybe get into more details. Thank you.
Okay. Dato, any ideas on, or maybe a Malaysian experience on the use of blockchain and NFT to protect an IP and how to finance it?
Well, I think we are, like I said earlier on, IPs, they are actually detachable entities. So I would say the blockchain maybe is a medium of presenting or a platform. Then you have cryptocurrency, which is actually another form of investment. And then we talk about artworks that are digitalized and also put into the public domain for sales. So those are actually individual IPs by themselves. What I have said earlier on, an IP is actually an idea, but has taken a form. And this form may or may not be legislated to protect, or it may have auto protection. So if you have an artwork and you have transformed it either digitally or in hard copies, and you put it in the public domain for sales, then it is recognized as an IP. And if it derives an income, then it is already a form of monetization. How you monetize it, that is another matter by itself. So if you ask NFTs whether they have IP value, yes, they have. But the thing is that sometimes when it comes to digitization, there is the question of the legal rights as against the economic rights. So the legal rights may be very long. So I mean, it may be protected by copyrights. Okay, copyright, of course, is a perpetual kind of ownership, unless the owner expires. But then the economic life is, how far or how long you can take it along the future to monetize it. With technology, sometimes the economic life is very short. So it depends on the market, whether the market still views the product as something that they would like to acquire, and then it has a value. If it is not, then the value is very low. But if you take it as a business, then what you can, how you go about valuing is you attach a value for a period of 3 to 5 years, with maybe a higher discount rate, but the terminal value can be very low. Yeah, so it's still valuing in perpetuality, but the terminal value will be discounted, with a very low kind of rate, you see. So whether you digitize your artwork or you have a hard copy, yes, it is an artwork, and artwork automatically, I think by the Berne Convention, is already recognized as a creation of that particular owner. Yeah, so blockchain and cryptocurrency, I think I don't have much to comment. To me, it is blockchain is a platform, and cryptocurrency is actually trust. So as long as there is trust, there is value. So it's like the US dollar, what is written on it, in God we trust. So it has a high value, that kind of thing. So basically, if you have an idea, you transfer into form, and it has a market, you can commercialize, then this viable IP value.
Dato, now come back to Pak Budi, your own question. Any comment on the NFT, cryptocurrency, blockchain, on the protection and valuation and monetization of IPs?
Yeah, the reason why I'm asking the question is because someone has asked me to do a valuation on an NFT, and I'm like, how? Say if I think NFT has a market, there is a buyer, there is a seller, and there is a price, and therefore potentially there is a value. Some have strong value if they come from, as Aviral said, Bollywood stars. We have Indonesian stars, famous Indonesian stars. What they might have a value because people are actually interested people are actually willing to pay for it, and people are actually willing to, as they say, what they call it, to subscribe to that business where the NFT comes in. So, for example, some movie stars are sharing their private moments, which is not available on the internet. And if you're a really, really big fan, you might be willing to buy that NFT, and that creates a price. And therefore, that is the only valuation we can get, because I cannot imagine how to create an income stream on NFT. Anyway, I also don't, I agree with Aviral. I think I'm going to have to buy one NFT just to try. Exactly. I don't have one, but all my friends do. So I think I'm going to have to buy one and to see. And maybe next time, Pa Triono, I can explain better on how NFT works and how much money I made from it or lost money on it. So next time, Pa. Thank you very much, Pa Triono.
Meet with Pak Budi, maybe not in Holy Bing, but probably in Holy Cow.
No. Holy cow! Oh yeah. By the way, Holy Cow, for all of you that don't know, is a seafood. I have to call it a steak restaurant, which is one of my favorite. Thank you.
Okay, a couple of questions from the audience, but I think this is quite critical in terms of us as a professional valuation advisors. What is actually required of us in terms of capabilities, skill set, expertise that we need to build? No longer we can rely on the traditional corporate finance and valuation skill set. Probably let me ask this first to Aviral. I mean, Aviral, you have the benefit of having Kroll as the world leading forensics investigation, and also Duff and Phelps corporate finance valuation, and also strong credit rating understanding. What do you think a good appraisers, valuers need to build in terms of competencies and skill set to tackle the future challenges of valuing IP that is getting harder and harder even to understand as we talk about the NFT and blockchain?
Yeah, sure. I think that's like 5 questions in one. We talked about so many service functions that, but yes, I think you're absolutely right here. Valuing an IP, valuation itself is a very subjective area. It keeps evolving. So if you're keeping, if personally, if I'm not learning every day, then maybe I'll also be left behind somewhere. But IP in itself is a different animal, and it's much more complex than the typical business valuations or an instrument valuations we look at, simply because IP, as I think Dato also mentioned and Budi also mentioned, on a standalone basis, the value could be very, very different from the value it is deriving as a part of the business, as a part of the current business. So from a valuer's perspective, first is really to identify what is the IP we are talking about. What are the rights associated with those IPs? And Dato actually went into the definitions and also certain conditions. For example, the transferability condition. Tomorrow you have an IP which is ingrained in your business, but you cannot transfer it out to a third party. It might be highly valuable, but if an investor cannot harness the value, then from a market perspective, it doesn't have really a third party value. So sometimes, very simple and small conditions. Let's say there is a lock-in condition, there is a bundle condition, there are some other business conditions because of which you cannot really move the IP out of one entity. I think that has a big impact on the market value of that IP. So that is one, to understand the role the IP is playing in the business is number one. And secondly, the economic conditions around it. The other aspect is really to understand the technical part of it. We have various approaches. We have income approach, market cost approach, variations of various approaches within that. Of course, I think as valuers, it is an understood, or it's an assumption that we'll be good at applying those approaches, but seldom you will find you can apply all the approaches to an IP. You have to really understand the nature of IP. You'll have to understand the economic benefits you will derive from it. And more importantly, how reliable the inputs you're getting for a particular approach. For example, you're using RFR, relief from royalty approach. Now, it's a very simple approach, one of the simplest approaches, and I love it because it's fairly simple to apply. But the biggest complexity in that approach is what royalty rate do you choose? You go to the various databases, you get a spectrum of royalty transactions. Maybe one transaction says 1% of revenue is a royalty, the other one says 5%, the third one says 10%, all the three in the same industry. Now, if you take a deeper dive, then you'll try and understand whether that 1% of sales, is it 1% of gross sales or net sales? Is there a additional economic condition on whether gross profit should also achieve a certain minimum levels when those say royalties are to be given? So if so the devil lies in the details. So if you get into details, you'll find that while you felt that you've got good transactions, the transaction might have its own nuances. Then sometimes these are exclusive jurisdiction transactions. Some of them are global license transactions. So I'm just giving you a glimpse of what kind of complexities you can get into as soon as you get into an IP inputs for IP valuation. The other part of the story is really to understand the business and have a corporate finance or a transaction cap on your head as well, because sometimes we are, as valuers, I remember my own times, we used to love Excel, right? We used to get numbers in Excel. You have these trends, you pull the data in, growth, margins, trying to put as much pressure you want to put on that Excel to get the desired outcome, right? And Excel will give it up. You run so many scenarios that you'll get, yes, this is the range. The problem is, as soon as you want to convert these Excel numbers into ground reality, into market reality, so the test of that Excel is, do you have a willing buyer for that? Do the investors outside in the market also believe in the story which you're trying to sell or which you have built in Excel? And that validity is the one which brings a lot of credence to the analysis. So you need to do triangulation. I think Dato mentioned about it. You need to triangulate the approaches. While we do not have IPs, let's say directly trading in the market, we need to look at precedents. If let's say a transaction took place in the same industry in the recent years, what is the kind of role that IP was playing? What is the brand revenue multiple, for example, or what is the kind of business that's being generated? Who are the market participants? So you need to look at the business, the landscape, and then get comfortable, with the underlying numbers. So it will require, a little bit on, I would say, comfort on the marketability of that asset before you really opine. And the final part is a little bit forensic and investigations in nature, since you mentioned about my firm, which is actually quite good in that. Typically, as valuers, we put a lot of caveats. We love putting caveats, right? We have not done this, we have not done an audit, we have not looked into, we can't verify these statements given by the management, etc., etc. But one large issue which I personally see is, the availability of fake substitutes in the market. You might have very good IP, you might be doing well, but it's only when you go to tier 2, tier 3 towns and figure out what are the substitutes in the market, because everyone knows metros very well. But if your sales are coming from pan country and half of your sales are in villages or towns, you need to see what are the substitutes, how is it affecting you, and how legally can you protect the IP in coming years. So that part, I think, usually as valuers we don't get into. We think it's out of scope. Neither the client wants to pay and neither we have any bandwidth to pick it up. But that's a very practical side of it, and one needs to do this a bit of diligence before getting comfortable. So these are the few aspects around it. I'll just take a 30-second and maybe share one example. This was few years back. Banks wanted to fund a brand, and the company wasn't doing well, so the company wanted to give its brand as an additional collateral. Banks hired us to do it. So typically, we run all these RFR approaches, multi-period access earning, cost approach, etc., which we also did. But before we did that, we actually we did a market survey. We we collated a list of cities in which that product was being distributed. We looked at the top distributors of those products, the wholesalers, middlemen, and the retailers. And then we did a survey, almost reaching out to almost 1,000 participants who are actually selling that product through various channels, wholesale, the middle guy, and then the end retailer, and try and collect inputs around the brand, around the availability, around the quality issues, around the service, customer service, etc., etc., etc. Now, while all those qualitative inputs came in, we realized that a part of the problem with that company was not with the product, but was with the availability and the turnaround on the customer service. So and while you cannot directly apply it in your model, but yes, it helped us challenge some of the assumptions we had taken and also which the management had given, and then go to the banks. See, this is what the management scenario says, but these assumptions seems very optimistic given the survey results, and this is what the scenario analysis says. So these are the kind of things one can do to get more comfortable with your analysis and making it more robust and perhaps more reliable. Thank you.
Thank you, Aviral. Dr. Lau, Aviral mentioned about the need to do due diligence on the market, a different kind of skill set that the valuation needs to have to properly value IP. You have any thoughts on that?
Yeah, this marginally covered in one of my slides, due diligence. So in carrying out the evaluation, the very first thing is the valuer actually has to do a due diligence on that company and its IP that you are valuing. And the due diligence could also cover questions that may be related to the expansionary or the business plan of the company, and in details like where they are expanding to, and their projected income, and who are the management, and who are the person who are in charge of the particular IP. Does he have a passion in it? Things like that. And it also, due diligence also, you as a valuer, you ask questions like, what is the marketability, or where is the market for the particular IP that you are valuing? And also, who are the competitors? What is the market share in the particular jurisdiction that you are valuing? So all this put into the due diligence as a questionnaire. And it's like I say, the factors to be considered are not created by the valuers. They should be provided by the owner, the business owner himself. So never create your own factors for valuation. But as a valuer, you do have professional knowledge, and you can advise the owner, and you may be able to ask questions such as, if you are expanding at 30% per annum of your particular business, where are you expanding to, or is that a realistic figure when in the past you are only expanding at 5%? So as a valuer, you have to be professional enough to also look into the data that is provided to you and ask pertinent questions. And as a valuer, end of the valuation, you can have caveats, you can have limitation clauses. I think that is practiced everywhere in valuation sector. And to say that valuation is an art and a science, well, I think the art part is really like getting smaller and smaller in terms of percentage. The science part is getting more and more important. So it applies to business IP valuations. The science part is still very important. Look at the facts and figures of the particular business. Do not just make assumption that whatever is given to you is given to us as a valuer is always correct. Never assume that. That is really very dangerous. Yeah. So as to the methods and approaches of valuation, Mr. Avril has actually mentioned quite a lot. And I did mention a bit, especially on the income approach, because most of the valuation are related, or most of the valuations are related to business. So the income approach is really important, and really from royalty is one of the very favorite method of valuation. So there are factors inside there. You have to be very objective. For instance, the risk factor that is attached to the particular business, that you have to be very careful about it. The weighted average cost of capital have to be reflective of risk as well. So, I mean, as a valuer, I think what applies to the real estate valuation actually also applies to the intangible asset valuation. It's just that the factors considered or maybe the guidance notes are slightly different. That's about it. But end of the day, ask yourself whether the value, the final value, is kind of reflective of the market. Yeah, so I think the income approach is kind of the best, the most applied. Of course, the comparison method, there is a lot of weaknesses because IFRS 13, they were mentioned, I think, about things like, you have to use level 1 inputs, which is for a business is really difficult. You really don't have an apple-to-apple comparison. Yeah, so that's why the income approach becomes the dominant approach when the business is already taking place. But at the beginning of the business, it is actually the cost method that we will employ because there is no income flow as at that point in time. Yeah, thank you, Pak Jono.
Thank you. Probably I'll give the last 2 minutes to Pak Budi on the challenges for MAPI members to expand their knowledge because the traditional valuation skill set is not enough anymore to deal with the challenges of the IP. They need to understand about the market, technology, legal, and so on. Your comment on that, Pak?
Yeah, as an IP valuer or an intangible asset valuer, it is, as I always say, it is one of the most complicated and most riskiest valuation we can do. Because as a valuer and MAPI members, when we do a valuation, we must follow the regulation and also must be able to defend assumptions. Valuing IP is tough. As Aviral said, sometimes what looks good on paper may not be good in reality. So sometimes when I'm appointed to do a valuation, my first question is, do I actually know this brand? Or do I actually know the product? If I do know it, then I might be able to put in a proposal. So for members of MAPI, if someone gives you a valuation of a product you do not understand, or you do not know how that business actually works or how that industry actually works, my suggestion is to find some industry expert to support you during your valuation. Because if not, as Aviral said, you may think that it is a good company, on numbers looks good, but that IP may actually be worthless because nobody actually wants to buy the product and you don't even know that. And that is why if you're doing an IP valuation in Indonesia, and if you do not understand the product or the industry, please get an expert that can help you. It might save your business. Thank you.
Okay. Thank you, panelists. Thank you for your excellent presentations, and thank you for very enlightening panel discussion. Before I give back to the moderator. And also probably we largely already addressed the questions. If you have any further question, you can send to the organizing committee. And without further ado, I will invite the MC to take over. Yeah.
Thank you so much, Mr. Triyono Sudirjo, and also our speakers, Mr. Aviral Jain, Mrs. Dato Lawesang, and Mr. Budi Marto Kusumo. It is such a pleasure for us to learn about intellectual property valuation for financing directly from the experts. We are looking forward to discuss more in the future. It's a very fruitful session today. Ladies and gentlemen, here we have the chairman of Indonesian Valuation Standard Development Committee who will be giving a closing remark. Please welcome Mr. Hamid Yusuf.
Ya, thank you, Bu. Assalamualaikum warahmatullahi wabarakatuh. Dear all webinar participants, with the end of this webinar, we hope that the several topics discussed before can improve our insight as a valuer. This event was held as a part of the road to the 24th AVA Congress, which will be held in Bali on November this year. We, on behalf of the organizer, would like to thank all speakers, Mr. Afiral from India, Dato Lau from Malaysia, Budi Marto from Indonesia, and Mr. Triono as a moderator. Hopefully, all of our participants will be able to attend the AVA Congress in Bali. Thank you and best wishes to you all. Wassalamualaikum warahmatullahi wabarakatuh. Selamat siang.
Thank you so much, Mr. Hamid Yusuf, for the closing remarks. Ladies and gentlemen, I would like to inform you that the links for the presentation material and certificates are available in the chat box and also in the YouTube description box. The link is available for access until today, 1 p.m. And also, as I mentioned before, in order to get the certificate, there's a keyword that needs to be submitted. Please note that the keyword is credible IP valuations. I repeat, the keyword is credible IP valuations. I also have a good news that the registration for the 24th ASEAN Valuers Association Congress that will be held at Hilton Bali Resort in Bali on November 22nd until 24th is already open. We are looking forward for your participation. Ladies and gentlemen, we have arrived at the end of our webinar. As MC, me and everyone involved in preparing this webinar sincerely apologize for any inconvenience. Thank you so much for your participation and see you in Bali.
Thank you.
Kasih,
Afira,
Pak.
Pak Datuk, Bu, Ibu Datuk, Lau, Budi.
Thank you, Pak Hamid.
Sama-sama.